Okay. So now please pay attention. We are going to continue with the balance part and we'll finish that part soon. Okay. Uh, did you solve one question which I gave yesterday? Huh? One question which I dictated and I told you to solve. How much answer you all got in that question? Final tax liability? 1 lakh? 1,80,070. Very good. 1,80,070 should be the correct answer. So the capital gain without indexation was 32,30,000. On that 15%. On that 15%. How much is that tax? 32,30,000 into 15. On that 12.5%. 12.5%. 3,97,500. And with indexation, the capital gain we had already calculated yesterday. Yes or no? On that 20%. 1 lakh? 73,000 something. Okay. This 1,73,000 or 3 lakh something, whichever is lower, whichever is beneficial, that we are going to pay. So ultimately that same tax which we were supposed to pay in the last sum, we are going to pay that tax only, because even if it is calculated at what rate? Even if it is calculated at 20%, still the taxable amount was very less, hence the tax is also less. Yes or no? So you want me to what happened, Surya? It's not working. Yes. Okay. Very good. So how will I have now? You took so much time to bring it. Bring it, I'll have it. Okay, now let's continue with section 47. Section 47 talks about exempt transfers. Exempt? There are many transfers in section 47 which are exempt transfers. Yes or no? Out of those transfers, few transfers we have already covered, like conversion of bonds into shares is an exempt transfer as per section 47. We have already seen that. Conversion of preference shares into equity is also exempt transfer. That also we have seen. Yes or no? Then there are other transfers in section 47. There are other transfers in section 47. Out of those transfers, only 2 or 3 transfers we are supposed to check. Okay? Because from the examination point of view, these transfers are relevant. Others you can skip. Okay? Others you can skip. So the first transfer, if you will understand this, if you will understand this, the next transfer which I am going to explain will become very easy for you. Okay? So please focus on this. Okay? See, if there is one HUF, and HUF is transferring its capital asset on its partition to any of its member. Now the partition can be complete partition, full partition, or partial partition also. But whenever the partition is taking place, at the time of partition of HUF, the HUF is transferring its assets to members. Now, for example, HUF acquired the capital asset on 11th November 2011. 11th November 2011. This is the date on which HUF acquired the asset. HUF acquired the asset. Okay, no? Now pay attention. And at a cost of rupees 1 lakh. At a cost of rupees. And this capital asset, whose cost was 1 lakh, is worth 1,50,000 as on the date of partition, as on the date of distribution. So when the partition took place, this same asset was given by the HUF to partner. The same asset was given by HUF to partner. And at that time when it was given, it was distributed to the partner. At that time, the value of that asset became capital asset. The value appreciates. Yes or no? So over a period of time, the value appreciated. When the partition took place? 18, 19, 18. On 13th December 2018. On 13th December 2000. On partition, the asset was transferred to the member. And on that day, the fair market value of the asset was? Can you see there is an appreciation in the value of rupees 50,000. The value of the asset has increased by 50,000. Now tell me, earlier the asset belongs to HUF and now that asset is gone to? Earlier the asset belongs to and now that asset has gone to? Member. Yes or no? Ownership is changing. Possession is changing. Hello? It is a transfer. It is a transfer from one person to another person. But tell me, is there any consideration involved? Is the HUF getting 1,50,000 or it is just the value as on that day? If the HUF would have transferred and received 1,50,000, only then this 50,000 would have realized in the hands of HUF. Even though during the period for which the HUF was holding the asset, there was an appreciation in the value of 50,000. That appreciation during the period for which the asset was held by HUF, that 50,000 would have been taxed in the hands of HUF if that 50,000 appreciation would have been realized in the hands of HUF. And that was possible only if the HUF would have transferred that asset and HUF would have received a consideration of 1,50,000. Is the HUF receiving 1,50,000 consideration? As on that date on which the transfer is made to the member, is the member paying 1,50,000 to HUF? So even if there is a gain of rupees 50,000 happening in the period during which the asset was held by HUF, even if that gain is happening, that gain will not be taxable in the hands of HUF. Should not be taxable in the hands of HUF. If that is done, it will be unnecessary hardship to HUF. And bloody, I am transferring my asset under a family arrangement. Family arrangement is happening due to which the partition is taking place, and due to this family arrangement I had to transfer this asset to my member. And during this family arrangement, if I am transferring, I am not recovering, I am not realizing that 50,000 gain happening during my period of holding. That's what the HUF will say. Yes or no? And if the HUF will say that, tell me, should it be taxable in the hands of HUF? No. So when the HUF is doing that transfer? When the HUF is doing that transfer? 13 December 2018, previous year. In the previous year 18-19, the transfer made by HUF. Transfer made by to it. So the transfer made by the HUF to its members on partition in 18-19, this transfer will be treated as exempt transfer. By exempting this transfer, this 50,000 gain is exempted in the hands of HUF, will not be taxable in the hands of HUF. Yes or no? Should it be taxed later on to the person who will realize this 50,000? It should be taxable in the hands of member who will now realize this gain also, and the gain which will happen during his period of holding. Now, with effect from 13th December, who will hold the asset? Who will hold the asset? At that time, what was the value of that asset? So, member will say that today the asset is coming to me. What is the value of this asset today? 1,50,000. I start holding the asset from today. So what is the value of this asset today? 1,50,000. Yes or no? And this asset, if the member is selling in 24, 25. Member is selling this asset in for how much? The asset which came to me, value of that asset was 1,50,000. And when I am selling, what is the value of, at what price I am selling? So during the period for which I was the holder of the asset, during that period only there is an appreciation of 90,000. Only that appreciation should be taxable for me. The member will say that. What will you tell the member? What will you say? Why? Because the appreciation happening in your period of holding is also realized in your hands, and the earlier appreciation which we exempted in the hands of HUF is also realized in your hands. So the both amount should be taxable in your hands. Logic or magic? Okay. Now see. So now keep these things in mind. Okay. The logic which we have discussed. Tell me, who acquired the asset? HUF. In the year? What was the cost? And partition of the HUF is taking place. In which year? In the year 1819, on partition, the HUF is transferring this asset to its, when the value of this asset was? So there is an appreciation in the value amounting to, which is not realized by HUF, so it should not be taxable in the hands of HUF. Hence, what did I say? Hence, in the year in which the asset will be transferred by the HUF to the member, in the year in which the asset will be transferred by the HUF to the, in that year, that transfer will be exempt transfer. No tax will arise, no capital gain, and no tax liability will arise in the hands of HUF in the year in which the HUF has transferred the asset to member. Tell me, in which year HUF has transferred? In which year HUF has transferred? So in the year 1819, the transfer will be treated as exempt transfer in the hands of, and accordingly this gain will not be taxable in the hands of HUF. 1819 done. 1819 done. Section 47 done. HUF treatment done. Now who is having the asset? When did the member acquire the asset? When did the member acquire the asset? 1819. Yes or no? And if the member acquired the asset in 1819, this asset member is selling later on. In 24? At what price? So at that time when the member will sell the asset, at that time when the member will you calculate the capital gains in the hands of member? So name of the assessee? Member. Name of the assessee? Individual ROR. PAN dash. Previous year? Previous year 24-25. Assessment year? Computation of which capital gains? Long term or? Depends on period of holding of the capital asset in the hands of assessee, in the hands of. So assessee started holding the capital asset from 13 December till, so this is the period of holding of the assessee, HUF. Wait, this is the period of holding of the assessee. We should have taken this period if only this gain was taxable in the hands of assessee. Is the assessee being taxed for this gain also? So don't you think that the gain relates to a period, even that period should also be included in assessee's period? Hello? So from where the period of holding should be counted? Should it be counted from 13th December or it should be counted from 11th November. 11th November to 9th June. This is the period of holding. This is the meaning the period of holding of the previous owner shall also be included in the period of holding of the assessee. Yes or no? Why? Because the gain of the period of holding of the previous owner is also to be taxed in the hands of assessee. So if the gain for his period is getting taxed in my hands, so I will take his period of holding also as my period of holding. Getting my point? So period of holding will start from, it will end on. Now based on this period of holding you are supposed to say whether the asset was short term or long term. What was the asset? For example, the asset was immovable property. Asset was, so immovable property, period of holding 11th November to 9th June. More than 24 months. Short term or long term? Long term. Long term capital asset. So the gain will be long term. Gain will be, now number one, full value of consideration. Come on, tell me, at what price the asset is sold? 2,40,000. This is the selling price. Wait. If this selling price is given and the stamp duty value as on the date of transfer is also given for immovable property, you will have to apply 50C also. You are lucky that only selling price is given. In the same question, the examiner can give you stamp duty value as on the date of transfer, and the amount of that stamp duty value was more than sale consideration. Then the sale consideration will be ignored and the stamp duty value will be deemed to be your full value of consideration if the difference is more than 10%. But we are keeping the thing simple. Sale consideration is full value of consideration. Okay. Minus. In the example, can you see any transfer expense? If there is transfer expense, we will reduce. If there is no transfer expense, no need to reduce. So what will be the net consideration? 2 lakh minus cost of acquisition. Now, please remember, the member will try to reduce this amount as cost, saying that if the asset has come to me, at that time what was the value of the asset, I will take that amount as my cost. Member will try to do that. What will you tell the member? Why? Because if you will take this amount as your cost, what will happen? You will end up paying tax only on the gain happening in your period. Did you take the period of previous owner as your period? Yes. Hello? Is his gain realized in your hands? Yes. So his gain should also be taxable in your hands, and that is possible only if his cost is taken as cost in your hands. Yes or no? His cost is also taken as your cost. Check the batteries. Some are working, some are not working. Okay. So what did I say? Cost of acquisition in the hands of previous owner shall be deemed to be the cost of acquisition in the hands of assessee. Yes or no? So what will be the cost in the hands of assessee? Should it be 1,50,000 or it will be 1 lakh? If you take 1 lakh and you reduce it from 2,40,000, how much will be the gain? 1,50,000. This entire gain will be taxed. Getting my point? Everyone? Now pay attention. 1 lakh is the cost of acquisition. 1 lakh is the cost to previous owner. Cost to previous owner. Now, any cost of improvement, any incurred by the previous owner, will also be allowed as your cost. Will also be allowed. Forget about member. Tell me, how much was the cost? How much was the cost of improvement? And what was the fair market value? If the HUF would have sold, for 1,50,000, how much would have been gain? It should not have been 50, it should have been 10,000. Why? Because out of 1,50,000, 1 lakh cost of acquisition would have been reduced, and 40,000 cost of improvement was also allowed as a deduction, no? So actually speaking, the gain for the HUF was not 50, it was only 10, because cost of improvement was also incurred. But if you will take this 1 lakh only as the cost, hello, then 40,000 extra gain will be taxable in your hands, because you did not take cost of improvement. So any cost of improvement, what did I say? Incurred by previous owner, incurred by, shall also be deemed to be your cost, shall also be deemed to be your cost. So cost of acquisition of the previous owner will also be treated as your cost, and any cost of improvement incurred by the previous owner will also be deemed to be your cost. Yes or no? Now tell me, you have the cost. Will you reduce 1 lakh? Yes. Will you reduce 1 lakh? Yes. Now 1 lakh with indexation or without indexation? Asset is long term. Asset is with indexation or without indexation? With indexation. Why? Because the transfer is made prior to 23rd July. Getting my point? So indexation will be available. Now to index, what we are going to do? 1 lakh multiplied by CII of transfer year divided by CII of acquisition year. Which year? 1819 or 1112? 1819 or 1112? 1819 or 1112? You have to take 1819. I know whatever you said is correct. We have to take for 1112 only. But what does the law says? Please listen to me carefully. Indexation is a benefit. Indexation is a which is available with effect from the previous year in which the assessee started holding the capital asset for the first time. Who is the assessee? Who is the assessee? When did he started holding the capital asset for the first time? So even if you are taking the cost of acquisition as 1 lakh, and if you go by the legal language written in the law, which says that cost to previous owner will be taken as your cost. Hello? Cost to previous owner will be taken as your cost. But if the indexation is available, indexation will be allowed with effect from the previous year in which you started holding the capital asset for the, when did you start? 1112. Did you start holding the asset from 1112 or 1819? So indexation will be available from 1819 to 2425 as per the plain reading of the law. Yes or no? So cost of acquisition 1 lakh multiplied by CII of 2425 divided by CII of 1819. What was the CII of 1819? CII of 1819, let's see. CII of 1819. CII of 1819 is 280. Calculate. 1 lakh 29,643. So what we did? We took the cost of acquisition multiplied by CII of transfer year divided by CII of the year in which member started holding the capital asset for the first time. In your main answer, in your indexation must be done like this, which is not correct. Which is not correct? No, this is correct as per the language of the law. But this is absolutely absurd and illogical. And for this, a case was also filed in the Bombay High Court. A case was also filed in the, I will tell you the name of the case. You will have to remember the name. The name of the case was Manjula Ben Jayantilal Shah versus CIT. What? Manjula Ben Jayantilal Shah versus CIT. In this case, Manjula Ben fought with the assessing officer. That have you gone mad? Huh? Allowing the indexation only for my period of holding, then charge the tax on the gain for my period of holding. Take the cost 1,50,000 and not 1 lakh. Bloody, if you are taking 1 lakh rupees as my cost, meaning the law wants me to pay tax on the period of holding, on the gain happening in the period of holding of the previous owner. And that is the reason why cost of previous owner and cost of improvement of the previous owner is treated as my cost, and the period of holding of the previous owner is also included in my period of holding. Then why I should not get the indexation benefit for earlier period? Assume as if I am holding the asset for the first time with effect from that date only on which it was held for the first time by previous owner. Or else, don't charge tax on this amount. Logical or not? Assessee won the case and the judgment was in the favor of Manjula Ben. Bombay High Court gave the decision that this is completely illogical. If the law says that the indexation benefit should be available with effect from the previous year in which the assessee started holding the capital asset for the first time, but wherever such situation arises, in such type of situation, it has to be assumed as if the assessee has started holding the asset for the first time since the beginning, since the time when it was held for the first time by the previous owner, and accordingly the indexation should be available from the beginning. The judgment came in the favor of assessee. Now, if the judgment is applied in our case, if the judgment of the Bombay High Court, if we apply the judgment in our case, what we are going to do? We'll take this cost of acquisition, hello, multiplied by CII of 2425, which is 363. Now divided by CII of 1819, no, divided by CII of 1112. And what was the CII of 1112? It was 184. Can you see 184? Now calculate. Now calculate. So 1 lakh into 360, 364 divided by 184. So here instead of 280, which is for 1819, we'll take for 1112. How much will take? 184. So this index cost of acquisition will change. It will. How much is the amount now? 1,97,000. Understanding or not? Now pay attention. Name of the assessee, member. Full value of consideration. Full value of 2,40,000. 2,40,000 minus transfer expense, nil. Net consideration 2,40,000. Cost of acquisition. Cost of acquisition. Cost to previous owner. Cost to will be indexed? Yes, because the asset was long term. Because the asset was long term. We took the entire period of holding starting from here to here. Asset was long term. And if the asset is long term and the transfer is happening prior to 23rd July, now we'll have to take the indexation. Indexation in the main answer, will be only for this period. That is what our institute does. 1 lakh into CII of 2425 divided by CII of 1819. Hence your index cost of acquisition will be 1,29,000 something something. Yes or no? In the main answer you are supposed to show that. But now compulsory one note you have to give. Compulsory one note you have to give. If the decision of the Honorable Bombay High Court, if the decision of the Honorable Bombay High Court in the case of Manjula Ben Shah versus CIT would have been applied in the above solution, then the indexation benefit would have been available with effect from the previous year in which HUF, previous owner, started holding the capital asset for the first time, in that case, index cost of acquisition would have been 1 lakh into 363 divided by 184, and in that case the index cost of acquisition would have been 1,97,000 something something. Yes or no? And the long term capital gain would have been this much. So we'll have to, in that case, calculate the long term gain also. Our institute presents all the answers in this manner. Check the ICS study mat, you will get this only. Getting my point? So, in the examination, if you have done only one part and not given the judgment of Manjula Ben in the note, there are bright chances that you will lose your marks. See, if you want the answer as per law, it is given above. And if you want logical answer as per Bombay High Court judgment, answer is given in the note. Both the answer, take any one you want, both are correct. But if you are going to give only one answer as per law or as per Manjula Ben judgment, then for the second answer which you have not given, you can lose the marks. Yes or no? Understanding? Now tell me, cost of acquisition reduced, indexation, did you understand? Now wait. Problem is only if the indexation is to be considered. Now if this date of transfer, was 9th August. So even if the asset is long term, but since the transfer is after 23rd July, indexation will happen or will not happen? Take only 1 lakh. Then no Anjula Ben, no Manjula Ben, nothing. Getting my point? But if indexation is there, no, then there is this problem. Got it, sir? Hello, sir. Now wait. Any cost of improvement of the previous owner will also be allowed as your cost. So what is the cost of improvement? 40,000 multiplied by CII of transfer year divided by CII of improvement. Here there is no problem only. Indexation will happen from the year of improvement till the year of transfer. So here don't go and try to apply Manjula Ben judgment. Manjula Ben judgment is relevant only in the case of indexation of cost of acquisition. Got it, sir? So now tell me, 40,000 multiplied by 363 divided by CII of 1516. What is the CII of 1516? It is 254. 254 into 363 divided by 254. 50? Okay, 57,000, no? 57,165. Where is the answer? See, 2,40,000 minus nil, 2,40,000, this is the index cost of acquisition, and 57,165. This will be your long-term capital gain. This will be your, why long-term? Because the period of holding was from 11/11 to 8 June, and based on this period of holding, the asset is long-term and long-term. Hence, we are doing the indexation because the date of transfer was prior to 23rd July. Done, sir? Now, will you get this answer? But wait. This is the answer if you don't apply Manjula Ben judgment. This is the answer if you don't apply. But if you will apply Manjula Ben judgment, everything will change, no? Everything will change? No. Full value of consideration remaining same, transfer expense remaining same, net consideration remaining same, index cost of improvement remaining same. Only this amount will change. How much? 1,97,283. So do one thing, 53,192 on your calculator. Take 53,192. You have got this gain after reducing this amount. Add this 1,29,643 and reduce this 197,283. You will get a loss. 14,448. So instead of writing 129,643 here, how much you will write? You will write 197,283. How much you will write? 197 283. And now 240 minus this, here instead of gain it will be a loss. 14,448. It will be a long-term capital loss. Understood or not? Everyone? Sure, no? This way your answer has to be presented. Now whatever we have done, no, we have done as per 49.1. As per. Now one question I would like to ask you. The member has acquired the asset in 1819. Member has acquired the asset in? Can I say in 22-23, member has also incurred some cost of improvement? Will he get the deduction for his cost of improvement? Yes. This is normal. Will he get the deduction for cost of improvement of previous owner? Yes. So now pay attention. If I say that if HUF has transferred the capital asset on its partition, to its members, So in the year of such transfer, no capital gain taxable, for HUF. Why? Since such transfer is what? Exempt under section 47. In the hands of. Sure, no? Such transfer will be exempt under section 47 in the hands of. Now this is the first part. Okay. Now tell me, after the asset is transferred to the members, now this member later on transferred the asset, which he received on partition from HUF. So here section 49.1 will be applicable. Section, wait. Member has bought the asset, acquired the asset by paying the money, or he has received the asset on partition of HUF. This asset became the property of the member. This asset became the property of the member on partition of HUF. He did not go in the market and bought this asset. If he would have gone in the market and bought the asset, then his cost would have been actual cost. Hello? Did he go to market to buy the asset? Or the asset became his property on partition of HUF? So this is a normal type of acquisition or a special type of acquisition? In this special type of acquisition, special type of cost should be there, which is given in 49.1. Member has acquired the asset. Assessee has acquired the asset by way of following modes. One mode is on partition of HUF. Second mode is gift. Third mode is will or inheritance. Next one is revocable or irrevocable transfer. Likewise, there are certain modes which are prescribed in 49.1. Modes which are prescribed in any of these modes. If the assessee has acquired the capital asset by way of any of these modes which are prescribed in 49.1, then cost to the previous owner. What did I say? Shall be deemed to be the cost in the hands of assessee. Shall be. and any cost of improvement incurred by the previous owner shall also be deemed to be the cost in the hands of assessee. Will you remember this, everyone? So 49(1) will become applicable. Why? Because this is the this is the mode which is prescribed under section 49(1). Yes or no? Now if 49(1) will be applicable, what are you going to do? Come on, tell me. If 49(1) will be applicable, so later on transferred by the assessee, transferred by the assessee means this member will transfer the asset later on. So on the transfer, in the year of transfer, capital gain shall be computed for member. Now to calculate this capital gain, full value of consideration will be taken minus transfer expense will be taken. Yes or no? You will get net consideration, and out of this net consideration minus cost of acquisition. This cost of acquisition will be as per 49(1). Cost of acquisition will be as per, what will be the cost of acquisition? Cost to previous owner, that is HUF, will be deemed to be the cost in the hands of partner, in the hands of assessee, member. Yes or no? And cost of improvement incurred by previous owner, who is HUF, also taken as cost for whom? Also taken as cost for member, meaning assessee, as per 49(1). Now pay attention. Whenever 49(1) will be attracted, whenever you will take the cost of the previous owner as your cost, so that time you will also have to include the period of holding of the previous owner in your period of holding. Yes or no? So if 49(1) is applicable and cost is determined as per 49(1), what will you do? Include the period of holding of capital asset in the hands of, include the period of holding of capital asset for previous owner, here in our case HUF, in the period of holding of the assessee. Who is the assessee? Member. Yes or no? Now based on this period of holding, asset is short-term capital asset. Asset is cost of acquisition and cost of improvement. Indexation or no indexation? No indexation, because the asset is still short-term. And what if the asset becomes long-term? Then cost of acquisition and cost of improvement to be indexed or not to be indexed? To be indexed if date of transfer by member is prior to 23rd July 2024, and the same cost of acquisition and cost of improvement will be indexed or will not be indexed? Will not be indexed if the date of transfer is on or 23rd July 2024. Will you remember all these things? But one very important thing, whenever you will do indexation, so indexation for cost of acquisition, indexation for index cost of acquisition multiplied by CII of year of transfer. Transfer by whom? Transfer by assessee. Assessee means member. Yes or no? And divided by CII of year of acquisition. Acquisition by whom? Acquisition by whom? Assessee only. Assessee means member. Yes or no? But this is what law says. This is what? And if the judgment of MJS, Michael Jackson sister, no, Manjula Ben Jayantilal Shah, if the judgment of Manjula Ben J Shah is applied, then index cost of acquisition will be calculated as cost of acquisition into CII of year of transfer by assessee. Yes or no? Member. And divided by CII of year of acquisition. Acquisition by whom? Previous owner, who is HUF. This is important. This is important. Don't forget this. And this happens only in the case of Manjula Ben. And if you don't apply Manjula Ben judgment, then acquisition year for the assessee has to be taken. Will you remember? Will you remember? So this was the end of the first exemption. Section 47 also we saw, and with section 47, for the other party to whom the asset is transferred, for the other party we have seen 49(1) also. So whenever you study section 47, don't read section 47 alone. Read section 47 along with section 49. Section 47 along with section 49 will give you a clear idea about what is to be done for one person and what is to be done for the other person. Will you remember? Hello? Now, write down one question. I am dictating. Write down one question. Now this question which I am dictating, no, this is not on HUF. The next part which I am going to discuss, yes or no, next exempt transfer which I am going to discuss, the question is on that. Getting my point? Write down. Beta. Mr. A acquired a capital asset on 9 September 2009 at a cost of rupees 1 lakh. At a cost of rupees 1 lakh. Full stop. He incurred cost of improvement. He incurred cost of improvement amounting to rupees 1 lakh in previous year 12-13. Previous year 12-13. Full stop. On 11th December 2013, this asset was transferred by him to his friend, to his brother. To his brother. Underline the word brother and put it in inverted comma. Okay. Brother Mr. B. when the fair market value was 4 lakh 50. When the fair market value was 4 lakh 50. Full stop. Later on, Mr. B, after incurring rupees 1,25,000, after incurring rupees 1,25,000 on the improvement of that asset, in previous year 18-19, transferred the said asset to Mr. C, on 12th July 2024 for rupees 10 lakhs. For rupees 10 lakhs. Next line, brokerage paid by Mr. B, brokerage paid by Mr. B at the rate of 2%, and stamp duty value at the time of transfer by Mr. B was 12 lakhs. Was 12 lakhs. Okay, full stop. This same question I will twist in 2-3 ways. Okay, so that you get an idea of each and every concept which we have studied. Questions will be, framed like this only, but few information here and there, they can change. So right now, with whatever information given, okay, write down, compute the amount of capital gains. Compute the amount of capital gains taxable in the hands of Mr. B. Taxable in the hands of Mr. B. Compute. Giving 5 minutes time. And apply the same logic which we applied in HUF and member. Because here also the same logic is applicable. This is the second exam transfer which we are going to do, but in the question directly. Getting my point? Very easy question, huh? Not at all difficult. Everything straight given. Pay attention here. Mr. A transferred capital asset by way of what? Gift. By way of gift. In which previous year? In previous year 12-13, no? When did 13-14, sorry. In the previous year 13-14. Now see, if any individual, what did I say? Any individual or HUF transfers the capital asset to any person, but the transferor should be individual or HUF. Transferor should be, there is an amendment here. Earlier what used to happen, any person transferring the capital asset to any person by way of gift etc., it used to be exempt. With effect from this year, Finance Act 2024, amendment is there. And as per this amendment, now this exemption is available only for individual and HUF. If you are an individual, if you are an HUF, transferring this asset, transferring your capital asset to any person by way of gift, will, inheritance or even the irrevocable trust. Gift, will, inheritance or irrevocable trust. By these modes, if you are transferring the asset, then the transfer will be an exempt transfer in your hands. So who is transferring? Mr. A. And transferring the capital asset by way of gift. In the previous year 13-14. In this previous year, no capital gain and tax liability for Mr. X. Why? Since such transfer is exempt under section 47. Now previous year 13-14 transfer already took place. That time the transfer was exempt. Now the transfer was made to whom? Mr. B. And who is Mr. B, guys? Mr. B is the brother. So for Mr. A, Mr. B is brother. So for Mr. B, A is a, wait, huh? For Mr. A, Mr. B is brother, younger or elder, I don't know. Mr. B is brother. So for Mr. B, who is getting the asset? For Mr. B, who is getting the asset? A is brother. So can I say for Mr. B, who is a recipient? Mr. A is what? Brother, who is a relative for Mr. So can I say whenever you get something from your relative, okay, whether sum of money, whether any asset, whether any sum of money or any asset, That sum of money or the asset which you are receiving, the sum of money or the asset which you are receiving, yes or no, that will be treated as your gift, taxable under the head IFOS. For example, the capital asset which was given, yes or no, as on the date of transfer, the for example, the stamp duty value of this was stamp duty value or fair market value. Let's take fair market value. Okay, no, the capital asset was jewelry. Capital asset was jewelry, and for this jewelry, as on the date of transfer, the fair market value was 10 lakhs. Fair market value was, this 10 lakhs would have been taxable in the hands of Mr. B as his gift if it was not coming from relative. Do you remember gift provisions are there under IFOS? So if you are receiving something as a gift and the value of that amount value of that gift is more than 50,000, then that amount is taxable for you. That value will be taxable for you as gift under the head IFOS. So forget about Mr. A. Discussion of Mr. A is over. For Mr. A, the transaction is exempt. But now talk about Mr. B. In 1314, when Mr. B will receive, when Mr. B will receive, at that time, will it be treated as taxable gift for Mr. B? No. Even if the value of the asset is more than 50,000, it will not be taxable as gift. It will not be taxable as for Mr. B. Why? Because it is coming from relative. It is coming from, getting my point? So now pay attention. For brother Mr. B, in previous year 2013-14, gift provisions will be applicable or not be applicable? Gift provisions under section 56 to 10. Gift provisions under section 56 to 10 will be applicable or will not be applicable? Not applicable. Even if the value is more than 50,000, still there will be no taxability under the head IFOS as gift because it is coming from relative. It is coming from, yes or no? Now pay attention. Now Mr. B, for whom the gift provision was not applicable, now the asset is with Mr. B. Now the asset is with Mr. Now later on, B transfers. B has transferred this asset. When did he transfer? Transferred in previous year 24-25. Now when Mr. B will transfer, can I say capital gain will be computed for Mr. B? Yes or no? Capital gain will be computed for Mr. B. Now let's see how to calculate this capital gain. Full value of consideration. How much? Full value of consideration. You have taken selling price or as per section 50C? As per section, because selling price was 10 lakhs. Stamp duty value was 12 lakhs. Yes or no? Difference is 2 lakhs. And that 2 lakh is more than 10% of 10 lakhs. 2 lakh is more than 1 lakh. Meaning 50C will be applicable or your sale consideration will be ignored. And what will be your full value of consideration? Stamp duty value 12 lakhs minus transfer expense 2%. Now, if you will take 2% of 12 lakhs, you are gone. 2% of selling price 10 lakhs. How much? 20,000 will be your transfer expense minus. Then it will be net consideration 11 lakh 80,000. Now, do I have to reduce the cost of acquisition? Yes or no? With indexation or without indexation? But for that, I will have to first check. First of all, I will have to determine what is the cost of acquisition. Now please be very careful here. Cost of acquisition will be determined under section 49(1). Will be determined under section, meaning cost to previous owner. Why, you know? Why? Because for Mr. B, at the time of receipt of this asset, gift provisions were not applicable and this fair market value was not taxed under the head IFOS. Hence, we will apply 49(1). Hence, we will apply 49(1). Yes or no? I will change this question, don't worry. But first of all, understand this thing. Okay, first we have to capitalize on 49(1). Once 49(1) is done, no, then different ways I will, exploit this same question. Don't worry. Pay attention. What will be the cost of acquisition? As per 49(1). See, there are different modes which are prescribed in 49(1). Partition of HUF, gift, will, inheritance, etc. Yes or no? So can I say gift is also a mode specified under section 49(1)? Mr. B has acquired the asset by way of gift, which is a mode specified under section 49(1). So what will be the cost in the hands of Mr. B? Cost of acquisition. Cost of acquisition for Mr. A shall be deemed to be the cost in the hands of Mr. B. Yes or no? So what was the cost of acquisition for Mr. A? 1 lakh? Yes or no? 1 lakh? You are very fortunate, When Mr. A acquired the asset? 9 September 2009. If I want, I can put you in trouble this also. Put you in trouble in this also. Mr. A acquired the asset in 93-94 for rupees 1 lakh. Incurred cost of improvement in 96-97, 25,000. And the fair market value as on 1st April 2001 for that asset was 2 lakhs. Now you cannot take the actual cost of Mr. A because Mr. A acquired the asset prior to 1st April 2001. There the option will be available. There the option to take the fair market value. What was the cost? 1 lakh. What was the cost? And even the cost of improvement incurred prior to 1st April 2001, everything will be covered by fair market value. Option to take the fair market value of 2 lakh will be available. So 1 lakh or 2 lakh, whichever is higher, 2 lakh will be cost of acquisition for Mr. A. And that will become the cost in the hands of Mr. B. But since the date of acquisition of Mr. A is 9th September 2009, on or after 1st April 2001. So actual cost needs to be taken as cost of acquisition. What is actual cost? 1 lakh. This will be the cost of acquisition of Mr. A. Yes or no? And any cost of improvement by Mr. A was how much? 1 lakh. Cost of improvement was also 1 lakh. Cost of improvement was also 1 lakh. Shall also be considered as cost in the hands of Mr. B. So now tell me, cost of acquisition is there. Will you index or you will not index? Why? Because see, the period of holding will start from, period of holding of the asset will start from 9 September 2009. That is the date of acquisition of the asset by Mr. A till the date of transfer of the asset by Mr. B. On what date Mr. B transferred? Tell me. 12th June 2000. This entire period of holding has to be counted. This includes the period of holding of the previous owner also, period of holding of Mr. B also. Yes or no? What did I tell you? Whenever 49(1) will be applicable, whenever 49(1) will be applicable, cost to previous owner will be taken as your cost. Cost of improvement of the previous owner will also be treated as your cost. And don't forget to take his period of holding in your period of holding. Meaning his period of holding will also be included in your period of holding. So your period of holding plus his period of holding, meaning I will have to start the period of holding from date of acquisition on which previous owner acquired. He acquired from 9 September and I transferred on 12th June. That is the total period of holding. Now based on this period of holding, asset is short term. Then cost of acquisition, cost of improvement, no need to index. Yes or no? But the asset is long term. Cost of acquisition will be index. Why? Because the transfer was prior to 23rd July. Yes or no? So I will take index cost of acquisition. For that, do I have a cost? 1 lakh. Multiplied by CII of which year? Transfer year. 24, 25. Now please be very careful here. Divided by CII of the year of acquisition. CII of year of the year in which Mr. B acquired the capital asset for the first time. Because we are not going to apply Manjula Ben judgment here. Getting my point? So tell me, which year CII you will take? When Mr. B acquired? When Mr. B acquired? He acquired in 13-14. So we'll divide the CII of 13-14. What is the CII of 13-14? Let's see. CII of 13-14 is 220. Yes or no? So we'll divide it by 220. I am writing this with different color so as to draw your attention that this is for which year? This is for the year 13-14. If we are not applying the judgment of Manjula Ben. Now tell me, how much will be the index cost of acquisition? 1,65,000. Exact 1,65,000 you are getting? Okay. Now tell me, will there be any index cost of improvement? Cost of improvement is also there. Two cost of improvements are there. Two cost of improvements are there. One cost of improvement incurred by Mr. A. When did Mr. A incur? Mr. A incurred in 12-13. Yes or no? So what was the amount of that? 1 lakh into 363. And the CII of 12-13 is 200. Yes or no? So then there will be no problem. One cost of improvement is also incurred by Mr. B. How much? 1 lakh 35,000. 25,000. And this was incurred by him in which year? 18. So divided by CII of 18-19, which will be 280. Yes or no? So this will be 280. Calculate first one. 1,81,500. Second one. 162054. Yes or no? Now please reduce. $11,80,000 minus 3 amount you are supposed to reduce. 6,71,440. Everyone got this? Did you understand? Pay attention now. Pay attention. Pay attention. This is the answer if you don't follow Manjula Ben judgment. But what if you follow Manjula Ben judgment? Wait. Here. Everyone. Will this remain same? Net consideration will remain. Will this remain same? Will this also remain same? Only this will change. Only this will change. Now, instead of 1 lakh into 363 divided by 220, what are you going to do? What are you going to do? 1 lakh into 363 divided by CII of the year of acquisition by previous owner, and previous owner acquired in 910. What was the CII? 140. So I'll write 148. This is the CII of 910. Now tell me, what will be the index cost of acquisition? 2 lakh 45,270. Yes or no? You have to just replace this amount by 245, 270 and tell me the amount of long-term capital gain. 5 lakh 91,176. In that case, the long-term gain will be this much. Yes or no? Understood? Easy, difficult? Made easy. These type of questions are really complicated, I am telling you. Now pay attention. Should I try to confuse you a little bit? Then I will eliminate the confusion myself only, don't worry. Pay attention. If you can, in the same question, no change. I will change one information. Can you see this? Huh? Not a relative. Not a. So Mr. B is a friend, for example. Instead of brother, he is a friend. So Mr. B is a friend of Mr. A and Mr. A is a friend of Mr. B. Now think from the perspective of Mr. A. Mr. A has transferred the asset to Mr. B, who is the friend. Will the transfer be exempt for Mr. A? The answer is yes. There is no requirement that you will have to transfer the asset to relatives. Under the head capital gain, section 47 says that if you are an individual or HUF, you have transferred the capital asset to any person, whether your relative, non-relative, any person, yes or no, that transfer is exempt for you. So for Mr. A, there will be no effect, no change. Getting my point? Transfer is exempt. Transfer is exempt for Mr. A. For Mr. A, transfer is exempt. Now let's talk about Mr. B. Mr. B receiving the asset from Mr. A, and Mr. A is a friend. Friend means relative or non-relative? And whenever you get an asset from a non-relative and the value of that asset is more than, gift provisions are attracted. Gift provisions are. Now tell me, for Mr. B, in the previous year 13-14, in the previous year, gift provisions will be applicable or will not be applicable? Here now for him the gift provisions will be applicable, and in the year 13-14 only 10 lakhs, which was the fair market value. 10 lakhs, which was the fair market value. Is it more than 50,000? Yes. This 10 lakh will be treated as income from other sources in the hands of Mr. B. First change, did you understand? Hello? For Mr. B, now the gift provision will be applicable because the asset received, the value of that asset is more than 50,000, and also it is coming from a non-relative. So if from any non-relative, if the asset is coming and the value of that asset is more than 50,000, then the entire value of that asset will be treated as my gift and it will be taxable. So for Mr. B, the entire 10 lakh rupees is taxed at the time of receipt of gift only. At the time of receipt of gift. Now tell me, Mr. B, in that same question, if instead of brother, friend was written, then what are the changes? Only one word they will change. Brother, no. Mr. B is a friend. These changes will happen. For Mr. B, the gift provisions will be attracted and the gift will be taxable. In which year? In the year 1314. The gift is already taxed. In the year 1314, gift is already taxed in the hands of Mr. B. Now, Mr. B is transferring this asset in 24-25. Capital gain will be calculated in the hands of Mr. B. Yes, absolutely. Full value of consideration. Will there be any change? No. Full value of consideration remain same. Full value of consideration will remain same. So there will be no change in the full value of consideration, 12 lakh. Transfer expense, same. Net consideration, same. Till here there will be no problem. Now there will be a problem. What was the cost in the hands of Mr. B? You took 49.1. You took 49.1. Why? Because Mr. B is getting the asset by way of gift, which is a mode specified under section 49.1. So if Mr. B is getting the asset by way of gift, which is a mode specified under section 49.1, what are you supposed to do? Take the cost of previous owner. Yes or no? Cost of improvement of the previous owner will also be taken. This entire thing will be wrong now. You will apply 49.1. You will apply only if the gift provisions were not made applicable for you. Only if the gift provisions were not made applicable to you. In the last example, gift provisions were not applicable on Mr. B. Hence we took 49.1. Now tell me, gift provisions are applicable for Mr. B or not applicable? Applicable. On the entire 10 lakh rupees, Mr. B has already paid tax under the head IFOS. Meaning from 1 lakh to 10 lakh. 1 lakh to 10 lakh. Whatever gain was there, that gain has already been taxed in the hands of Mr. B under the head IFOS as his gift. And still you are taking 1 lakh as cost. What will happen, you know? That gain which has already been taxed in your hands under the head IFOS as your gift, it was not taxed for Mr. A, so it is taxed in your hands as your gift. Now that same amount will be again taxed in your hands under the head capital gain if you will take 1 lakh rupees as your cost. 49.1 if you will apply, no. What will happen? That gain which has already been taxed earlier in your hands will now be again taxed in your hands in the form of capital gain. Why? You took 1 lakh as cost. Cost to previous owner. What was? 1 lakh. And if you will take that 1 lakh as your cost, bloody that entire amount starting from 1 lakh to 9 lakh, which is already getting taxed in your hands as your gift, this entire amount will again be taxed in your hands as capital gains. You want to pay tax on this amount twice or only once? So you have already paid tax once, no? Now instead of applying 49.1 here, what are you going to apply? What are you going to apply? You are going to apply 49.4. What are you going to apply? Which says that the fair market value, or in the case of immobile property, stamp duty value is there, yes or no? But in our case, the asset was jewelry. And what was the fair market value? 10 lakhs, yes or no? So the fair market value which was considered for what? Gift provisions. Which provisions? Gift provisions under section 56 to 10 under the head IFOS shall be deemed to be the cost of acquisition. Don't take 49.1, otherwise you are gone. So ask yourself, assessee, gift provisions were made applicable? Assessee will say no. Go to 49.1, cost to previous owner. Then then cost of improvement of the previous owner, period of holding of the previous owner, Manjula Ben, everything, then you do that. Hello? But assessee, gift provisions were made applicable. Assessee will say, yes, when I received the asset, the value of that asset got taxed in my hands under the head IFOS as my gift. Ayo, don't take 49.1. Assessee, no need to follow 49.1. What will you follow? Whatever fair market value of this asset which has already suffered tax in your hand under the head IFOS as your gift, entire fair market value you can take as your cost. Entire fair market value you will take as your cost. Now ignore the cost of improvement and everything. Everything will be taken care of by this 10 lakhs. Yes or no? So tell me. Now instead of 1 lakh, what are you going to reduce here? Instead of 1 lakh, what are you going to reduce here? The cost will be as per cost of acquisition here will be as per 49.1 or 49.4. So here the cost will be as per 49.4. So here 49.4 will be applicable, and as per 49.4, what was the fair market value? Fair market value under section 56 to 10 taxed under the head IFOS was 10 lakhs, and now that 10 lakh will be treated as your cost of acquisition. But wait, if you are taking this 10 lakh as your cost, if you are taking this 10 lakh as your cost, don't you think asset is sold in? Asset is sold in 24-25. Asset is sold in 24-25. If the asset is, instead of this 10 lakhs now, let's take only 4 lakhs. Let's take only 4 lakh. Why? Because otherwise the loss will be there. So I am just updating that 10 lakh rupees amount. Instead of 10 lakh fair market value, how much is that? 4 lakhs. Only 4 lakhs. Yes or no? Because my selling price is very less, no? My selling price is very less, no? So I don't want to calculate a loss here. I want to calculate a gain. Okay? Getting my point? So tell me, what was the amount? 4 lakh. This 4 lakh has already taxed under the head IFOS. So take this 4 lakh as your cost. Now tell me, what will be the period of holding of this asset? Mr. B, what will be the period of holding of this asset? If 49.1 is applicable, no? Only then include the period of holding of the previous owner. Is 49.1 applicable here? Will you include the period of holding of the previous owner? So your period of holding will start from your date of acquisition. Date of acquisition of A. Date of acquisition of, B. So what was the date on which it was given as gift? 11th December 2000, and from this date your period of holding will start till the date on which you are transferring. So have we taken your period of holding only? Have we taken your period of holding? What is your period of holding? 11 December 2013 to 12 June 2024. Now based on this period of holding, tell me, cost will be indexed or will not be indexed? It will be indexed because the transfer has taken place prior to 23rd July. So can I say 4 lakh will be the cost multiplied by CII 363 and divided by CII of which year? 13-14. So what is the CII of 13-14? It is 220. Yes or no? 220. Calculate. 6 lakh 60,000. 6 lakh 60,000. Everyone getting this? Pay attention. Again. Cost of improvement incurred by the previous owner. You will take it your cost only if you apply 49.1. Are you applying 49.1? Ignore his cost of improvement. Only take the fair market value which was taxed in your hands under the head IFOS, which you have already taken. But wait, will you reduce your cost of improvement? Yes or no? Have you incurred any cost of improvement? That is how much? Minus index cost of improvement, that was 1 lakh, 1,25,000 multiplied by 363, and in which year it was incurred? 1819. What was the CII? 280. That will remain same. How much? 1 lakh 054. That is going to remain same. Now calculate the capital gain. 3 lakh 946. This will be the long term capital gain. Same question, only one word they have changed. Instead of brother, friend. And see, the entire answer changed. Now if you will talk Manjula Ben, no, I will become very angry. Only in case of 49.1 Manjula Ben judgment you are going to discuss. Otherwise no need to discuss Manjula Ben judgment. And now see, I'll give you a very layman understanding of whatever we have done. See, what was the cost of the asset when A bought? And when that asset was given to B, at that time what was the fair market value? 4 lakh. And when the asset was sold by Mr. B, it was sold for 10 lakh, but we did not take 10 lakh, we took 12 lakhs. Yes or no? Here to here. And here to here. Can I say total gain is how much? Total gain 11 lakhs. The asset which is, whose cost is 1 lakh, sold for 12 lakh. Total gain is how much got taxed under the head IFOS? Out of 11, how much got taxed under the head IFOS? 4 lakhs. So how much should be taxed under the head? Under the head capital gain, how much should be taxed? Only 7 lakhs? Yes or no? Getting my point? Total gain is 11 lakhs. Okay, no? Out of that, how much got taxed under the head IFRS? 4 lakhs. And how much balance should be taxable under the head capital gains? 7 lakhs. So for that, out of 12 lakh, 4 lakh has to be reduced. Out of 12, 4 lakh has to be reduced. Reduce 4 lakh. 8 lakhs. Sir, but you said only 7 lakh should be taxable under the head capital gain. Bloody, for you entire 12 lakh is gain. Did you pay a single rupee for the asset? Mr. B, you got the asset free of cost, no? Mr. B, you got the asset free of cost, no? So what was your cost? 0. And you are selling that asset for 12 lakh. So your gain should be 11 or 12? 12. Out of that, 4 is already taxed under the head IFOS. So balance 8 should be taxable under the head. So out of 12, how much cost should be reduced? 4. 12 minus 4. Balance 8 lakh taxed under the head. But sir, capital gain is different this much. Bloody, because of indexation it is coming less. Otherwise, see, this 4 lakh you have reduced. So 12 minus 4 is 8 lakh gain, which is getting taxed here. Getting my point? Now it is reducing. Why? Because of transfer expense, because of indexation, because of cost of improvement and indexation. That is the reason why the gain does not remain 8 lakh, it reduces more. If you exclude what? If you exclude the indexations, if you exclude the cost of improvement, if you exclude the transfer expense, then 12 lakh minus 4 lakh is how much? 8 lakh. That is getting taxed under the head capital gains. Pure logic I am telling you. Okay? If you remember, then it is well and good. Don't remember, then also well and good. But remember the tax treatments. Okay? Should I move ahead? Understood or not? This was the most complicated part. of the chapter, most complicated part. Now, the same type of question they will give you in the exam, and in this question, they will try to manipulate the things. Like, if you have the question in front of you, in that question they are saying that the assessee acquired the asset. What type of asset it is? Not given. They will tell you immobile property. They will tell you date of acquisition by Mr. A. Date of acquisition by Mr. A. It will be prior to 1st April 2001. Actual cost will be given. At the time of buying, what was the actual cost? What was the buying expenses? That will be given. Brokerage, this, that. And they will give you the fair market value also. They will give you the cost of improvement incurred by Mr. A prior to 1st April 2001 also. And along with the fair market value as on 1st April 2001, they are going to give you stamp duty also as on 1st April 2001. Every damn single thing, what we have to do, we have already checked everything. Getting my point? How will you determine the cost? You will take fair market value or stamp duty value, whichever is lower, and you will take actual cost, whichever is higher. That higher will be the cost in the hands of Mr. A. And as per 49.1, if 49.1 is applicable, as per 49.1, that will be your cost. And for you, 49.1 will be applicable only if the gift provisions were not applicable on you. Only then you are going to follow 49.1. Got it, sir? Hello? And if gift provisions are made applicable, then no need to determine the cost of Mr. A. No need to determine the cost of Mr. A. Just determine what was the fair market value as on the date on which Mr. A transferred, because that amount will be taxable for you under the head IFOS as your gift. As per 49.4, you are supposed to take that fair market value as your cost. Ignore the period of holding of Mr. A. Take only your period of holding. Hello? Indexation only for your period of holding. No Manjula. Because 49.1 is not applicable. Why 49.1 is not applicable? Because gift was taxed in your hands. Understood? Should I move ahead? Okay. Sir, this was the last part. Okay. This was the last part of section 47. Yes, done. You received these notes, no? Okay. Now see, balance part which I am not touching is not actually relevant from examination point of view. Questions are framed on the concepts. Those, all the concepts I have covered. Okay. I've tried my best to cover all those concepts, not to leave a single concept. Okay. But few things which are there in the theory in my notes, if you will read, you will understand. Okay. Now pay attention. See. Sovereign gold bond. You read this part. I have already explained sovereign gold bond. Okay. Reverse mortgage scheme. No need to waste your time. Conversion of gold into electronic gold receipt. No need to do. Just read it once. Only relevant for theory. Can you see 49.4? I have just now covered this section with the question which we have already solved. Okay. Everything which I have mentioned, explained, will be given in the notes. Okay. Now let's come to the last part of second last part of the chapter, exemptions. Do you remember exemptions are there? Hello? Exemptions are given in section 54. Okay. Now if you will calculate your capital gain, no, from your capital gain, some capital gain we are going to exempt. But for that you need to invest your capital gains. You need to invest. So based on the investment of your capital gain, we are going to give you the exemption. Wait. First exemption, section 54. First exemption, section 54. Are you an individual or HUF? Assessee is an individual or assessee is an individual or HUF. Assessee has transferred a residential house property as long-term capital asset, as, and the capital gain will be calculated, will be long-term. Now this long-term gain will be with indexation, without indexation, no need to worry. The gain should be long-term capital gain. The gain should be, on this gain you are supposed to pay tax. But if you don't want to pay tax on this gain, if you don't want to pay tax on this gain, we are going to give you exemption out of this gain. Do you want to take the exemption out of this gain? Yes or no? Then do one thing, make some investment. Make some. Where are you going to make your investment? Anywhere? No. A residential house property, gain of residential house property will be exempt if investment is made in another residential house property. If investment is made in, so whatever investment you have made in another residential house property will be assumed as if that investment is out of this gain. Hello? Whatever investment you will make in another residential house property will be assumed as if that investment is out of this long-term capital gain of this residential property. For example, you have a property in Chennai. So this property you sold and the long-term gain is there. So this is the long-term gain of Chennai property. If you want to claim the exemption of this long-term gain, you have to invest in another property. Invest in, so that another property can be in Chennai, can be somewhere else. Yes or no? For example, one more property you have purchased. Another property you have purchased. You have purchased in Hyderabad. Where have you purchased? Hyderabad, another property you have purchased. So it will be assumed that whatever amount you have invested, cost of the Hyderabad property, the amount you have invested, cost of the Hyderabad property, whatever amount you have invested to purchase that property, it will be assumed that the amount of that property is met by this long-term capital gain. It will be assumed as if that investment is made out of this long-term capital gain, and accordingly this long-term capital gain can be exempted. Getting my point? So now, for example, the long-term gain is 3 crores. How much? 3 crores rupees of long-term gain. Another property you purchased, purchase cost of another property was 2 crores. It will be assumed that the cost of new property is met from this 3 crores of gain. So how much was your gain? 3 crores. Out of that, how much you invested? 2 crores will be exempt and the balance 1 crore will be taxable. Will you remember this? Hello? Sir, but the cost of my new property was 4 crores. Cost of my new property was, and the capital gain was. It will be assumed as if the entire 3 crores is invested. Hello? In that 4 crore, entire 3 crores is invested and 3 crores capital gain will be exempt. Nothing will be taxable. So can I say your investment should be higher than or equal to capital gain? Your investment should be higher than or equal to capital gain. Full capital gain will be exempt, assuming that entire capital gain is invested. So what will be the cost of the new property? Investment means cost of new property. Cost of new property, investment equal to capital gain or more than capital gain, full capital gain will be exempt. But what if the cost of the new property is less? Cost of the new property is, meaning the investment is made out of this gain, but entire gain invested? No. So to the extent of cost, the capital gain will be exempt and the balance which cannot be invested will be taxable. Will you remember this? So do one thing, amount of investment, meaning the cost of new property, or amount of capital gain, whichever is lower, whichever is, that will be the amount of exemption. Take this exemption out of your long-term capital gain. This exemption will be applicable for all, as I say, no, only individual HUF. Who is transferring? Any capital? No, 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 no. Only house property or residential house property? The property should be a residential house property. Assessee should be individual or HUF. And he has transferred any residential house property, and any long-term capital gain on this residential house property will be exempt under section 54, provided the assessee has invested in another residential house property. Another. So can he invest in the purchase of another residential property? Yes. Can he invest in the construction of another residential property? Yes. But sir, he had purchased a property 5 years back, or he will purchase a property 3 years after, 5 years after. So the property which you are selling right now, hello, the property which you are selling right now, the gain of this property will be assumed that it is invested in new property, and you will be eligible for exemption only if the new property is purchased within given time. Only if the new property is constructed within given time. We are giving you time. Within that time, whatever property is purchased, within that time, whatever property is constructed, we will assume that any property purchased or constructed within this time is purchased or constructed from this gain. Hello? And any property which is new property which is purchased or constructed within this time, within, will be assumed that this property within this time purchased or constructed from this gain only. What if purchased or constructed beyond time? For that property, the capital gain cannot be claimed exempt by investing in such property. Getting my point? So for example, your residential property was in Chennai. Where was the residential property? Tell me. Chennai. Now, this property was transferred. Date of transfer of this property you are supposed to see. What? Very important data, very important date. For example, the date of transfer of the property was 18th November 2024. I'll take this year. So your Chennai property was transferred on 18th November 2024. Yes or no? '24, '25, '25, '26, '26, '27. Okay. Wait, huh? Okay. So tell me, this is your previous year, 24, 25. In this previous year, date of transfer of your Chennai property was 18th of November 2024. Now this is very important date. 1 year backward. 1 year meaning the period which is exactly within 1 year prior to this date, prior to the date of transfer. 1 year immediately prior to your date of transfer, or 2 years immediately after the date of transfer, or 3 years immediately after the date of transfer. So what is your date of transfer? The property whose long-term gain you want to claim as exempt. So you have to check the date of transfer of that property. What is the date of transfer? 18 November. 1 year backward. 1 year meaning the period which is immediately prior to this date. 1 year period which is immediately prior to this date. Can I say 18th November 2023? 2 years period after this date. Can I say it will be 18th November 2026? 3 years. It will be 18th November 2027. So from this date 1 year backward, 1 year backward, 2 years forward, or 3 years forward. Yes or no? So, this is the period during which the property should be purchased. This entire period is given for what? Purchase of your property. Purchase of your property. This entire period. Okay. And what is the period given for construction? For construction, this period is given. This. Date of transfer, after that 3 years. So this is the period during which the construction should happen. During this period, the construction should happen. Now, whatever investment you have done for purchase within this year or construction within this year is completed. Within this period, the construction is completed. It will be assumed. It will be as if that investment is made out of, this long-term gain. Long-term gain of this property. So long-term gain of this property should be invested 1 year backward, 2 years forward, or 3 years forward. Yes or no? Now within this period, whatever property you have purchased, the cost of that property, it will be assumed that the cost is met out of this long-term capital gain. So accordingly, to the extent of cost of that property, your long-term gain can be claimed as exempt. Will you remember this? Hello? But tell me, don't you think that this period is too much? Because before this only, your due date of ROI for previous year 24, 25 will come here. Due date for filing your ROI. What will be your due date? Let's take an example. It is 31st July. 31st. So 31st July 2025. 31st July 2000. On or before this due date, you have to file the return of this year. Yes or no? On or before this due date, you have to file the return of this year. Now when you will file your return on or before the due date, in that return you are going to show this long-term gain. And in that long-term gain you are supposed to claim the exemption. Understanding or not? For example, you are going on 31st July to file your return. In that return, will you show the long-term gain of Chennai property? Yes. Because the return belongs to 24-25, and in 24-25, if I have earned long-term gain, that long-term gain I will have to show in the return. Hello? In the income tax return, I will show my long-term gain of Chennai property, and from that long-term gain, if I have to take exemption. So I will be able to take exemption only if I have purchased or constructed within this time. Purchase or construction should happen within this time. Only then, based on that purchase or construction, my capital gain will be exempt in my return. Yes or no? But do I have more time, some more time to purchase or construct? Yes. If I purchase or construct in this balance time also, then also the capital gain can be exempt. But I have to file my return, and in that return, if I am showing my capital gain, from that capital gain, if I have to take the exemption, then I cannot exploit this period. Then I have to anyhow purchase or construct on or before the due date of filing my ROI. What if I was not able to purchase within this time, construct within this time? Will I have to file my return? Yes. Will I have to show my capital gain? Yes. But from that capital gain, will I be able to claim the exemption? No. Even if I have some time, still I will not be able to take the exemption, because on or before the due date of filing ROI, I have not purchased a property, or I have not constructed a property. So in my return, I will have to show the entire gain taxable, even if I have some more time remaining to purchase or construct. Getting my point or not getting? You want me to repeat this once more? Sure? Understood? Now tell me. It is a practical difficulty for assessee that even if I have some more time available to invest and get the exemption of my capital gain, still I will have to pay tax on the entire gain. Why? Because I could not purchase or construct on or before the due date of filing my ROI. So the government gave you one additional way. Whatever amount you want to invest in the balance period, which you could not invest here, yes or no? Can you buy a new property? No. Could you construct a new property? No. Till the due date, if you could not purchase or could not construct a new property, don't worry. On or before the due date of filing your ROI, on or before that amount which you want to invest in the new property, you can deposit that amount in CGD account. Which account? CGD. Capital Gain Deposit Account. What did I say? Capital Gain Deposit Account, which you can open with any nationalized bank. Go to any nationalized bank like SBI is there, Punjab National Bank is there. Tell them that you want to open a CGD account, just like a savings account, just like a current account, just like overdraft account. There is a CGD account facility over there. So go and tell them that you want to open a capital gain deposit account. But this deposit account has to be opened prior to due date of filing your ROI, and in that account, on or before the due date of filing your ROI, deposit an amount. Whatever amount you will deposit in that account, we will assume as if that amount is invested in property. As if that amount is invested in, and based on that amount also you can claim the exemption. It will be assumed that your long-term capital gain is invested in another property, even if you deposit the amount in CGD. But remember, the amount which you deposit in CGD on or before the due date of your ROI, on or before that amount you will have to withdraw, and in the balance time you are supposed to use that amount for purchase or construction within the balance time. So within this much time, the amount from CGD has to be withdrawn and should be used to purchase another property. Only then the exemption will be only then the exemption will be retained. Otherwise the exemption will be taken back. Getting my point? And within the balance period of 3 years, another property should be constructed, and in that property's construction, the amount of CGD should be invested. But you invested in CGD, took the exemption, and now within the balance time, you are supposed to use that amount in purchase or construction of another residential property. You are withdrawing that amount and using it for some other purpose. Meaning, it is utilization of CGD or misutilization. Whatever amount you have withdrawn from CGD and misutilized, whatever amount you have withdrawn and misutilized from CGD, to that extent, it will be treated as your deemed long-term capital gain, because that is the same amount which you got exempted from us. Yes or no? So it will be treated as deemed long-term capital gain in the year in which the amount is misutilized. Now pay attention. You invested 10 lakhs in CGD account. How much? So you told the government that, see, I am investing 10 lakh in CGD account, this amount I will withdraw, and within the balance period I will purchase or construct a new residential property. Yes or no? So you have to withdraw this entire amount and you have to invest this amount in purchase or construction within the available time. Hence, on the basis of that promise, we are giving you the exemption of 10 lakhs. Capital gain invested in CGD 10 lakh, to the extent of 10 lakh, capital gain was exempt. Now what are you doing? 2 years are over. 2 years are over. No. Now I am not there. Huh? Preview projector. Preview projector. Oh, this one. Call someone. No. Vasant. Call no. It's not working. Huh? It's getting stuck. All of a sudden it is getting stuck. Now see, you came, no? You stay here only. Stay here for some time. If some problem is there, please fix it. Okay? Huh? See. Wait. Now, 2 years are already gone. You invested how much in CGD? 10 lakhs. Okay? 2 years are gone. Still no property is purchased. These 3 years are also over. Still no property is. Now tell me, after the expiry of 3 years, your CGD account will show how much balance? 10 lakhs. This 10 lakh, when you deposited, that time you promised that you will withdraw that 10 lakh and within available period of 2 years, within the available period of 3 years, you are going to use that amount for purchase or construction. Bloody 2 years are also over, 3 years are also over, and still your CGD account is showing some unutilized balance. Meaning that the balance which is shown unutilized on the expiry of 3 years, on the expiry of, was not used for the purchase, and neither it was used for, and still for this amount you claimed a exemption from us. That amount which is remaining unutilized, that amount which is remaining in your CGD account for which you claim the exemption, that entire amount will be deemed to be your LTCG. In which year? In the year in which the period of 3 years expires. Will you remember this? So first of all, tell me, are you an individual? Are you an individual or a chair? You are transferring what? Residential house property as long-term capital asset, and long-term capital gain you are getting. So this long-term capital gain will be exempt under section, provided you invest in purchase, construction, or you can also deposit. What you have to purchase? Another residential property. What you have to construct? Another residential property. Or you can deposit in CGD account for purchase or construction of another residential property. Yes or no? In India. In India. So property purchased outside India. Property purchased. You cannot say that I have used my long-term gain to purchase a property outside India. Even if you say that long-term gain we will not exempt. To the extent of that investment, long-term gain will not be exempted. You have to invest in India, invest in or deposit in CGD and withdraw amount, purchase a property in India, construct a property in how many properties? One residential house property in India, purchase within this time. One residential house property in India, construct within this time. Sir, within this time, I have purchased 2 properties. Both properties are purchased within time. Hello, sir. Investment in both properties will be considered or only one? Any one. Yes or no? Sir, within these 3 years, I have constructed 2 properties. Investment in both the constructed properties will be considered or only one? Only one. Yes or no? Any one you decide. Getting my point? But investment in both the properties is made from this gain, and to that extent your capital gain be exempt? No. Investment in any one property is made out of this gain and the capital gain will be exempt. Getting my point? Sir, one purchase is allowed, one construction is allowed. Sir, meaning 2 allowed? No. Or one purchase, one constructed. Both will qualify or any one will qualify? Any one. That you decide. That within this time, if you have purchased, we have constructed one, and within this time, if you have purchased one, then whether you want to consider the investment made in purchase or you want to consider the investment made in construction, that you decide. But both will not qualify. Yes or no? And you will deposit the amount in CGD within how much time? On or before the due date of filing your ROI, or actual date of filing your ROI, whichever comes earlier. Yes or no? So this amount also you will withdraw, and you are supposed to use this amount in purchase or in construction of any one residential house property in India. Getting my point? Now pay attention. CGD account deposited, and based on that capital gain got exempt. CGD account deposited, and based on that you got the capital gain exempt. If the amount deposited in CGD, you got the exemption, misutilized, remaining unutilized. What is to be done? I have already told you. Yes or no? But wait. Now, either you would have purchased or constructed a property here. Either you would have purchased or constructed a property here. Whatever investment in this property, whatever cost of this property was there, to the extent of that the capital gain was exempted. Hello, sir. So, investment in the property, cost of the property, or you would have deposited in CGD, withdrawing that amount and investing in this period also in the cost of the property. So cost of the property purchased or constructed, cost of the property purchased or constructed, yes or no? The cost of that property is nothing but investment of capital gain. Investment of capital. To the extent of that cost of the property, your capital gain is exempted. Lock-in period of that new property is 3 years. From the date of its acquisition or date of completion of construction. So the date on which you have purchased the property, acquired the property, new property, or the date on which the new property is constructed, from that date for 3 years the property should not be sold, should not be transferred. Otherwise, if you will transfer the property within these 3 years, which property I am talking? New property, whose cost, to that extent capital gain is exempted. Yes or no? New property, whose cost, to the extent of which the capital gain is exempted, that new property should not be transferred within 3 years from the date of its acquisition or completion of construction, as the case may be. If it is transferred within 3 years, if it is transferred within, we will take back the exemption from you. We will take back the revocation of exemption. Exemption was there in the cost. Exemption was there in the cost. So to the extent of that cost will be reduced to the extent of exemption. For example, 3 crores was what? Capital gain. Capital gain was? Investment in new property was? So can I say this is the cost of acquisition of the new property? This is the cost of acquisition of new property, yes or no? Now, entire 3 crore is invested, so entire 3 crore is exempted. Entire 3 crore invested, meaning entire 3 crore exempted, yes or no? Now, this new property you are selling in future within 3 years. For 6 crore you are selling it. How much? So will you calculate the capital gain? Yes. 6 crore minus cost. 4 crore? No. 6 crore will be the full value of consideration of transferring the new property, minus the cost of the new property, which was 4 crores. You will not be allowed to reduce 4 crores. No. Out of this 4 crores, 3 crores was the capital gain, which we exempted. To that extent, the cost will be reduced. How much will be your cost now? Only 1 crore. So from 6 crore, you would have reduced 4 crores, your capital gain would have been 2 crores. No, now the capital gain will be 5 crores. How come? Because 4 crores entire cost we are not going to allow. Out of this 4 crores of cost of new property, 3 crores we have already allowed you exemption. So to that extent, the cost will be reduced. To that extent, the cost will be. So tell me, how much will be the cost? 4 minus 3, it will be 1. So out of 6 crore, instead of reducing 4 crore cost, you are going to reduce only 1 crore. So your capital gain, instead of 2 crores, it will now be 5 crores. Your capital gain increased by 3 crores. This is exactly the same amount which got exempted earlier. Getting my point? Now what if the capital gain was 3 crore? What if the capital gain was? And the cost of acquisition of the new property was 2 crore. Tell me, entire 2 crore is exempted? Out of 3, 2 is exempt and 1 is taxable. Meaning this entire cost is met out of capital gain. Entire cost is met out of. So entire cost, to that extent the capital gain was exempted. Now this property you are selling in future for 6 crores. 6 minus 2, your capital gain should have been 4 crores. But tell me, out of this cost, how much capital gain was earlier exempted? 2 crores. 2 minus 2? 0. No cost will be allowed. And the capital gain will be 6 crores. Getting my point? Your capital gain increased by 2 crores. Instead of 4, now you are going to pay tax on 6. Got it, sir? Easy or not? But wait. Simple thing. If your capital gain amount on transfer of residential property is less than equal to 2 crores, then you can purchase or you can construct or you can deposit in CGD for purchase or construct of 2 residential properties. So investment in 2 residential properties will be considered for exemption under section 54. Investment in 2 residential properties can be considered for exemption under section 54. But for that, your capital gain should not be more than 2 crores. So if your capital gain is up to 2 crores, that capital gain can be invested in 2 properties to claim the exemption. Yes or no? Wait. This is once in a lifetime option. So this year your capital gain was 1.8 crores. What was the capital gain? 1.8 crores. Is it less than 2 crores? This capital gain can be invested in 2 properties. So you bought 2 properties and the investment in both the properties you claimed as exempt from this capital gain. This option is gone. Now in future, will you again get the exemption under section 54? Yes, yes, yes. But even if your capital gain will be less than 2 crores, you will not get the option to invest in two properties, because that option you have already exploited in this year. Getting my point? But what if your capital gain is more than 2 crores? Invest only in one property. Any one property investment will be considered. Yes or no? So tell me here, investment in new residential property. Okay. If the amount of long-term capital gain on the residential house property is up to option to invest in two residential property, both the investment can be considered out of this gain, and this gain can be exempt to the extent of both the investments. Getting my point? But this option is once in a, meaning that again in future, if you sell some residential property and again the long-term gain was up to 2 crore, can you claim this exemption again? Yes, the exemption can be claimed again. But option to invest in two properties will not be available now. This is once in a lifetime option. Hey, hello. I'm not saying that this exemption is once in a lifetime exemption. See how many times you can sell the property as long-term gain, that many times you can claim this exemption. Getting my point? This year I took the exemption. After 3-4 years, again I can take the exemption. After 4-5 years, again I can take the exemption. But every time I have to invest in one property. I have to invest in. Option to invest in two properties to get the exemption is available only once, provided the capital gain is up to 2 crores. Got it, sir? What if your long-term gain is more than 2 crores? What if your long-term gain is more than, can I say your long-term gain was 15 crores. Possible, not possible? Now, you can invest only in one property. So for example, you invested in two properties. One property investment is 15 crores. Second property investment in the second property is 13 crores. Both the investment can be considered for this exemption, or only one? Only one. Which one? Whatever you like, yes or no? So definitely the higher one you will like. How much you have invested? 15 crores. Any investment in the property over and above 10 crores. Over and above will be ignored. Will be ignored. So what was your capital gain? Tell me. 15 crores. So to take this exemption, you will buy a new property or you will construct a new property for 15 crores or more. Yes or no? For 15 crores or more. So for example, you bought a new property and the cost of new property was 15 crores. Thinking that the entire capital gain will be exempt. How much is the investment in the new property? How much is the investment in the new property? Is this investment more than 10 crores? Any amount of investment over and above 10 crores will be ignored. Will be. So how much is the investment? 15 or 10? Whichever is. So investment in new property up to 10 crores will be counted. Either this amount or your capital gain. Whichever is lower. So how much will be exempt? 10 crores, and the balance 5 crores will be taxable. Should I give you one more example? See, your capital gain was 12 crores. Capital gain was. So investment in new property was 8 crores. Are you investing in the new property more than 10 crores or up to 10 crores? Full investment can be counted. Full investment can be counted because investment over and above 10 crores will be ignored. So what is the investment limit? 10 crores. Is your investment within the limit? Yes. This or this, whichever is lower. Entire 8 crore investment will be considered. Entire 8 crore investment will be either 8 crore or 12 crore, whichever is lower, 8 crore will be exempt and the balance 4 crores will be taxable. Yes or no? Same example, same example. What is the capital gain? 12 crore. Investment in the new property is 16 crores. You thought that if I will invest 16, no, the government will assume that I have invested entire 12, so I will get the entire 12 as exempt. So you invested how much? Invested how much? How much is the maximum limit? 16 or 10, whichever is. So out of the entire 16 crore investment, only 10 crore investment will be eligible for exemption. Yes or no? So 10 crore. And what is the amount of capital gain? 12 crore. Whichever is lower, 10 crore will be exempt and the balance 2 crore will be taxable. Will you remember this? This is the end of section 54. Section 54. Now this section 54B is homework for you. You will read it. Okay? Only change is assessee name is same. Nature of gain is changing and type of asset is changing. Type of everything is same. What is the asset? Urban agricultural land. So which new asset you are going to buy? Agricultural land. Can be urban, can be rural. First section, residential property going, investment in residential property, another residential property. Second section, which asset is going? Urban agricultural land is going, investment in another agricultural land, maybe urban, maybe rural. See, building can be purchased, building can be constructed, or CGD. Land can be purchased, land cannot be constructed. So there is only one option, either to purchase. And if you cannot purchase within time, CGD option is available here also. CGD amount is invested, then amount misutilized from CGD, amount remaining unutilized in CGD. Whatever discussion I have done in section 54, equally applicable here also. New property, new asset. What was the minimum lock-in period? 3 years. So what is the minimum lock-in period here also? 3 years. If transferred within 3 years, the capital gain exemption will be revoked. How? It will be reduced out of the cost of new asset. To that extent, the cost will not be allowed. We did know. Same thing will be done here. So instead of repeating the same things again and again, what are the difference? Urban agricultural land. Capital gain, short term, long term, both can be exempted. Yes or no? Now the investment has to be made in another asset, and that another asset should be agricultural land, any agricultural land, whether rural or urban. Yes or no? CGD option available here also. And new agricultural land should be purchased within 2 years? No, purchased within 2 years. 2 years after the date of transfer of original land. So the date on which the original land is transferred, from that date, within 2 years, you have to purchase new land. Okay? And if the new land is purchased within this time, what will happen? It will be assumed as if this capital gain is invested, and the investment in the new asset, to that extent your capital gain will be exempt under section 54B. 2 years time is a small time or a long time? And before that, what if your due date comes and you are not able to purchase? Then CGD option is available here also. Getting my point? CGD, misutilized, unutilized. Urban agricultural land, for which you got the exemption. New urban agricultural land in which you invested, and on the basis of that you got the exemption under section 54B. If that urban agricultural land is transferred within 3 years, then whatever exemption which was there in the cost of this land, that exemption, to that extent the cost will be reduced, the exemption will be revoked. We did the same thing in 54. Understanding? Now, next section, 54D. Compulsory acquisition of any land or building used for industrial purpose for at least 2 years immediately prior to its compulsory acquisition. So there is some land or building with you. There is some land or building with you which is used by you for industrial purpose. That land or building was compulsorily acquired. So the date on which it is compulsorily acquired, the date on which it is compulsorily acquired, immediately prior to that, for minimum 2 years, it was used for industrial purpose. Now, if it was compulsorily acquired, so on compulsory acquisition, capital gain will be calculated under section 45(5). On compulsory acquisition, always the capital gain is calculated under section 45(5). Do you remember that? Whenever there is a capital asset which is compulsorily acquired, on the compulsory acquisition of a capital asset, profit or gain will arise, and that will also be taxable. 5,000 years ago, we discussed that point, 45(5) specific charge. Do you remember that? So in 45(5) the capital gain will be calculated. Yes or no? And that capital gain which will be calculated under section 45(5), out of that capital gain, whether it is short-term gain or long-term gain, you are going to get exemption under section 54(d). But to get this exemption, what are you supposed to do? Investment. Where are you going to do investment? Either you purchase or you construct. Purchase what? Land or building for industrial purpose. Construct what? Building for industrial purpose. Purchase within 3 years. Construction within 3 years from the date of transfer? No. Since the transfer is not normal transfer, transfer is by way of compulsory acquisition. So whenever there is a compulsory acquisition and you want to determine this time you are always going to determine with effect from date of receipt of compensation, because that is the year in which this gain will be taxable, and the gain is not taxable in the year of transfer. So why are you taking date of transfer? Take what? Date of receipt of compensation. From that date, within 3 years, new land and building has to be purchased. Hello? For industrial purpose. New building must be constructed for industrial purpose. Sir, this 3 years time is a small time or a long time? Before that the due date will come, and within on or before the due date you are not able to purchase, you are not able to construct. What will happen? CGD option is available. So you can invest in the CGD and withdraw the amount, and after withdrawing that amount, later on that amount can be utilized for purchase or construction of industrial land or building. Yes or no? What if the amount withdrawn is misutilized, remaining unutilized, new asset, transferred within 3 years? Everything is same. Got it, sir? Will you remember this? Hello? 54(EC). 54. Now this exemption is available to all persons. All who is transferring any. Try to remember section 54. Residential property. Is it an immobile property? Yes. 54(b). Urban agricultural land. Is it an immobile property? Okay. So 54(d). Land or building for industrial purpose. Is it an immobile property? Are they telling you residential property should not be there? Urban agricultural land should not be there? They are telling you any immovable property. All immobile properties are included. Any immobile property you transfer, resulting long-term gain can be exempted under section 54(ac). But to take this exemption of this long-term gain, what are you supposed to do? You are supposed to invest. Now the investment you have to do in notified bonds. Notified bonds of NHAI, bonds of RECL, bonds of Power Finance Corporation and IRFC. NHAI, National Highways Authority of India. Rural Electrification Corporation Limited, Power Finance Corporation and Indian Railways Finance Corporation. Yes or no? You are supposed to purchase the bonds of NHAI, RECL, PFC or IRFC. These are the notified bonds. So whatever amount you will invest in the purchase of these bonds within 6 months from the date of transfer of your immobile property. So the date on which your immobile property was transferred, from that date within 6 months, whatever amount you will invest in the purchase of these bonds, we will assume as if it is invested out of this long-term gain, and to that extent your long-term gain will be exempted. But remember, the total investment in your bonds cannot be more than 50 lakhs. You remember in section 54 also there was a limit. Total investment in new residential property cannot be more than, any investment over and above 10 crores will be ignored. Only the investment till 10 crores will qualify for 54 exemption. Yes or no? Here also the same logic. You have invested 30 lakhs in the bonds. How much? Entire 30 lakhs can be considered because the limit is maximum 50. Limit is maximum. What if you have invested 80 lakhs in the bonds? Any investment in the bonds over and above 50 lakhs will be ignored. Only the investment up to 50 lakhs will be considered. Will you remember this, sir? Hello. Now this investment has to be made within 6 months forward, means from the date of transfer of your immobile property, you are supposed to count 6 months forward. Yes or no? After the date of transfer forward. Getting my point? So the investment has to be made within where? Notified bonds. Maximum amount of investment 50 lakhs. Any investment over and above 50 lakhs will be ignored. Done? No? Wait. 6 months is a very big time or a small time? And in that you want CGD? We will not give. No CGD option available here. Because bloody, if you want to invest in these bonds, directly invest in the bonds. No. What is the logic? That no, I will first deposit in CGD, then I will withdraw from CGD, and from that I will use the amount in notified bonds. No. If you want to buy, you can directly buy. No need to invest in CGD for that. And that period of 6 months is also limited. So we are not going to give you any CGD benefit here. Getting my point? CGD benefit is available for 54, 54B, 54D, and not available for 54EC. Will you remember? Any person can claim this exemption under section 54EC. Companies can claim, partnership firm can claim, individual HUF, all types of associates can claim exemption under section 54EC, provided the long-term gain is from any immobile property, and that long-term gain is invested in notified bonds within 6 months, and the maximum amount is, now the lock-in period of the bonds is 5 years. Within 5 years, if you will transfer the bonds or you will keep the bonds as a security to get a loan, gone. Entire exemption which you got by investing in these bonds will go away. Why? Because you transferred the bonds within 5 years. You kept the bonds as a security within 5 years to take a loan, or within 5 years these bonds cannot be converted into money also, meaning no redemption should also happen. So within 5 years, can you sell the bonds? No. Within 5 years, can you keep the bonds as a security to take the loan? No. Within 5 years, can your bonds be converted into money? No. If within 5 years any of these activities will happen, any of these defaults happen within 5 years from the date of purchase, what will happen? Whatever exemption you got by investing in those bonds under section 54 EC, that entire amount will be deemed LTCG. The amount invested in such bonds which you took exempt under section 54 EC, that entire amount which you invested in the bond claimed as exempt will be deemed to be your long-term capital gain, taxable in the year in which you have committed that default. Will you remember? Hello. Now this was your 54 EC. Okay. Now after 54 EC, there is this important section 54F. Many times they exploit this section in the exam. See, out of all the 5 sections which we have done, no, most important in section 54, 54 EC and this section 54F. In 54F, see up till now, what used to happen? This is your capital gain. This is your capital gain. And this is your investment. Investment means cost of new asset. Cost of new asset. Yes or no? So this capital gain and this cost of new asset, meaning investment. Every section so far, what you have seen? This investment is out of. So this capital gain is invested. Capital gain is invested. So your investment is directly proportional to whatever investment is happening out of your capital gain. To that extent your capital gain is exempt. If you are investing more or investing equal to capital gain, meaning entire capital gain is invested, claim the exemption, yes or no? But if you are investing less, meaning less amount of capital gain is invested, less amount of capital gain will be exempted, yes or no? So far whatever investments you have seen in all the sections, are speaking this only, that your capital gain is invested. Capital gain is invested. Now in section 54F, in section 54, if you are an individual or HUF, please pay attention, please pay attention, very important point. If you are an individual or HUF, you have transferred, you have transferred what? Any capital asset. Did I identify the capital asset? Did I say residential property? Did I say urban land? Any capital asset you can transfer. But the capital asset which you are transferring should not be a residential house property. Other than residential property, you transfer any capital asset. Can you transfer jewelry? Yes. Can you transfer shares? Yes. Can you transfer land? Yes. Can you transfer any building? Yes. Any building which is not residential, yes or no? Transfer any capital asset other than, and then if you will transfer this asset, the date of transfer of this asset will be there. So as on the date of transfer of this asset, assessee, what did I say? Shall not be the owner of greater than 1 RHP. Additional requirement. Which asset you will transfer? Jewelry. Let's say example jewelry. But as on the date of transfer of jewelry, you should not be the owner of more than 1 residential property. See, if you will transfer residential property, gain of residential property cannot be exempted here. Gain of other asset will be exempted. But if you want to claim the exemption of gain of other asset, you have to make sure you are not having more than 1 residential properties as on the date of transfer of that asset. Did you understand the difference? Which asset you will transfer? Other than? On the date of transfer of that asset, you should not have a single house property, or you should have 1 property, not more than 1. Only then the long-term gain of this property, long-term gain of this asset will be exempted under section 54F. So to claim the exemption, it is a condition. said any capital asset, long-term gain we will exempt. Any capital asset, long-term gain we will exempt. But that capital asset should not be residential property. That capital asset should be some other asset. That capital asset should be some. And as on the date of transfer of that asset, the assessee should not own more than one residential property. That is the condition to claim the exemption. Will you remember this? Now, to claim this exemption under 54F, what are you supposed to do? Investment. Here also you are supposed to invest. Where will you invest? One residential house property in India. One residential house property in India. Option to invest in two properties not available here. That is available only in the case of section 54. Provided your long-term gain from residential property was up to 2 crores. That 2 crores option is not available here. Option to invest in two properties not available. If you have to invest, you have to invest in one residential property. Yes or no? Within 1 year backward, 2 years forward. If you want to purchase. If you want to construct, then within 3 years. 3 years forward. Yes or no? But since this time is very long and you could not purchase or construct on or before the due date of filing your RY, don't worry. We will give you the option of CGD also. Understanding? Pay attention. What are you transferring? Let's take an example. Shares. What are you transferring? Shares is a long-term capital asset or a short-term capital asset? Based on the period of holding. For example, shares are long-term capital asset based on period of holding. Will the shares give you long-term gain? So this is the long-term gain of shares. Long-term gain of can be exempted under section 54F, provided as on the date of transfer of shares, as on the date of transfer of assessee is not having any residential property, or he is having maximum one residential property, not more than that. Only then the long-term gain of shares will be exempt. Yes or no? But to claim this exemption, to claim this, investment has to be made. Investment has to be purchase of one residential property in India, construction of one residential property in India, or CGD. And you know the time limit within which the purchase has to be made. Yes or no? Now tell me, if you purchase within this time, if you will construct within this time, or you deposit in CGD within this time, it will be assumed as if the investment is made out of? It will be assumed as if the investment is made out of? No. The net consideration of the shares. In this section, it will not be assumed as if the investment is made out of capital gain. No. It will be assumed as if the investment is made out of? As if the investment is made out of? Now pay attention. Which was your asset? What was your asset? Your asset was shares. Now for this asset, you would have taken full value of consideration minus transfer expense. You would have got net consideration. Net consideration of shares was 10 lakh rupees. How much? 10 lakh. And out of this, cost of acquisition, cost of improvement, everything you would have reduced. And what would have been your long-term capital gain? Long-term capital gain would have been, example, 2 lakh rupees. How much? How much? Now, if you want to claim this exemption for this, out of this 2 lakh, if you want to claim the exemption out of this, you will have to invest. You will have to in one residential property in India. Purchase, construction, or CGD also. Yes or no? For purchase or construction later on. Getting my point? Within the time. Now whatever investment, for example, you have invested. For example, you have invested in new residential property or invested in CGD. Up till now, we were thinking that the investment is out of LTCG. Out of Here they are saying that whatever amount you are investing, whatever amount you are investing in new property or CGD, either the investment in new property or the investment in CGD is out of net consideration. So tell me, how much was the investment? Example, the investment was 10 lakhs. Investment was, or it can be 8 lakhs also. Let's take an example. The investment is 8 lakhs. Investment is 2 lakh rupees of capital gain, fully invested. 2 lakh will be exempt. We used to do that, no? No. Now this investment of 8 lakh is out of net consideration. Tell me, entire net consideration invested or only 80%? So entire capital gain should be exempted or only 80%? Only 80%. Proportionate. Got it? Hello. So out of 2 lakh, how much should be exempted? 2 lakh into 8 lakh divided by 10 lakh. 2 lakh into 8 lakh divided by 8 divided by 10 will give you 80%. And that 80% you apply on 2 lakhs. How much will be exempt? Exemption will be 1,60,000. Even if your investment was more than capital gains, still your full capital gain is not exempted. Why? Because investment is not out of capital gain, investment is out of net consideration. Will you remember? Yes or no? Now sir, if I have invested 18 lakhs, if I have, how much is the investment? 18 lakhs. Can I say 100% of net consideration has been invested? And 8 lakh more, yes or no? 100% of net consideration also invested and 8 lakh extra, meaning 100% of net consideration invested. So 100% capital gain will also be exempted. Getting my point? These amounts will not be this much easy. After looking at the amount, no, you will confuse. I will say how the amounts will appear. Net consideration is 32 lakh 11,460. This is your net consideration. And what is your capital gain? The amount of long-term capital gain was 7,32,880. This is just for the sake of understanding. In the real problem, real question, you will get these kind of amounts. What are you going to do? And they are saying that this is the net consideration on transfer of jewelry. Did you transfer jewelry? Yes. Did you transfer jewelry? Yes. As on the date of transfer of jewelry, you did not have any house. Or you have one residential house. Very good. Section 54F, conditions are fulfilled. Now, if I will invest in residential house, if I will invest in, this long-term gain can be exempted. This long-term gain will be, now investment in new residential house was 28 lakhs. 28. My first question. Investment is out of, can you see entire net consideration getting invested or only the part? So only the part of long-term gain will be exempted. Now first of all you will have to calculate the ratio. How will you calculate? 28 lakh divided by 32 lakh 11,460 into 100. How much? 87 point something. Yes or no? That you apply on 7 lakh 32. 6 lakh 38,000 982. This will be the amount of exemption. And if you don't want to do that, do one thing. Take LTCG on your calculator. 732,880 divided by 32 lakh 11,460 multiplied by 28. Formula. Capital gain multiplied by investment divided by net consideration. You will get the same amount. Do simple thing, no. Take the percentage and apply that same percentage on this gain. What if, sir, investment is full amount of consideration invested. So full amount of capital gain will be exempted. Don't do cross multiplication. Try. Do one thing, 7,32,880. Take 732,880 on your calculator. Divided by 32,11,460 and multiplied by 35. 7,98,700 and I will then and that time come in the exam. If you do this, bloody your capital gain is only 7,32,000 and you are taking an exemption of. You are taking an exemption of that income which you are not earning only. Ayyo, so smart. SRO number. Amount invested is more than net consideration. Yes, then no need to take the proportion. Full amount invested, full capital gain exempt. You will do the proportion only if amount invested is less than. Getting my point? Everything is same. Understood? So now tell me, are you an individual or HUF? Individual or HUF? What are you transferring? Any capital asset other than? Now, why residential property is excluded? Because bloody the investment has to be made in new property. Don't you think residential property long-term gain, I am investing in residential property, I am already getting section 54 exemption. And if this residential property is not excluded from here, what I will do? I will take the exemption for that same investment again under section 54F also. Not to be given twice. Once you are claiming, no? Where? Section 54. Long-term capital gain of residential property invested in another residential property. You are claiming the exemption under section 54. Now that same, for that same investment, you should not be eligible to claim exemption under 54F. Hence, except residential house property, any other capital asset you transfer, the long-term gain of that asset, any other asset, will be exempt under section 54F. If the net consideration of this asset is invested in any residential property within the given time. If investment is greater than or equal to net consideration, will you apply the formula? Amount of investment is more than net consideration, meaning full net consideration invested. So full capital gain exempt. But what if the investment amount is less than net consideration? Apply the formula. And what is this formula? You already know. Long-term gain into investment divided by net consideration is the proportion of net consideration getting invested. To that in the same proportion your long-term gain will also be exempt. Yes or no? Hello? So net consideration of any capital asset to be invested for exemption, the net consideration has to be invested where? Purchase, construction, or has to be deposited. Purchase, one residential property in India. Construction, one residential property in India. But if this cannot be done on or before the due date of filing your ROI, do you have the option to deposit? CGD. Now tell me one thing, one simple thing I am asking you. What was your net consideration? 10 lakhs. What was your capital gains? 4 lakhs. What was your capital gains? So this is your net consideration and this is your long-term capital gain. Now see, Out of this net consideration, amount has to be invested. Now where you have invested? CGD account. Where you have invested? Now how much you have invested in CGD? Example, you have invested 8 lakhs in CGD. Where have you invested? In CGD. How much? Are you investing full amount or 80%? So from this also 80% will be exempt. So how much exemption you are going to take? Exemption under section 54F will be how much? 3,20,000. Yes or no? Now tell me, how much you have invested in CGD? How much you have invested? Did you get the exemption of 8 lakhs? Did you get the exemption of 8 lakhs? On investing 8 lakh in CGD, you got the exemption of. Now out of this 8 lakh, 1 lakh rupees was withdrawn. 1 lakh rupees was, and it was misutilized. What we have been doing so far, whatever amount which is misutilized will be treated as your deemed capital gain in the year in which it is. If you'll do it here, no, gone. You are misutilizing out of 8 lakhs. 8 lakh was not exempted. How much was exempted? Against 8 lakh, if 3,20,000 was exempted, so from this 8 lakh, if 1 lakh is misutilized, against this 1 lakh, how much was exempted? Can you cross multiply? For 8 lakh, amount of exemption was 3,20,000. So out of this 8 lakh, on 1 lakh, how much amount should have been exempted? How much? This 40,000 will be your deemed LTCG in the year in which 1 lakh will be misutilized. Don't take 1 lakh as deemed LTCG. Otherwise the answer will be wrong. Yes or no? Now tell me. 7,50,000, not 7,50,000, 6,50,000 was utilized. Utilized means after investing in CGD, that amount was withdrawn, and within the available time of 2 years and within the available time of 3 years, that was used for purchase or construction. So this amount is utilized. And the capital gain relating to this amount will still be exempt. The capital gain relating to this amount will be still exempt. Now tell me, 3 years will expire. 3 years will. So on the expiry of 3 years, will there be any unutilized amount in my CGD? Check and tell me. Out of 8 lakh, 1 lakh was, and 6,50,000 was. So can I say 50,000 will be still unutilized on the expiry of 3 years. On the expiry of, from the date of transfer of original asset, from the date of transfer of original asset, 3 years. 3 years expired, still 50,000 is there in CGD. How much capital gain against this 50,000 was exempted? If against 8 lakh, this was exempted. So out of 8 lakh on 50,000, how much gain was already exempted? 20,000. Yes or no? Now this 20,000 will be treated as your deemed LTCG. Yes or no? So meaning that how much exemption total you got? How much total you got? Out of that 40,000 was already considered as your deemed LTCG. Reversed. Yes or no? And 20,000 also treated as your deemed LTCG. Again this was reversed. Getting my point? So tell me, how much is still remaining? 2 lakh. This 2,60,000 is the capital gain still remaining exempt under section 54F, because this is related to this 6,50,000 which was utilized. If you want to do the cross multiplication, you can do. For 8 lakh it was, for 8 lakh it was 3,20,000. How much should be for 6,50,000? Cross multiply, you will get the same amount. And this 2,60,000 will remain with you forever. Yes, provided this new residential property, this new residential property is not transferred within 3 years. If you transfer this new residential property within 3 years from its date of acquisition or date of completion of construction, as the case may be, then this 2,60,000 will also be revoked. It will be treated as your deemed long-term capital gain in that year in which the property is transferred. You are not supposed to reduce out of cost as you used to do in earlier sections. Directly consider this amount as your deemed LTCG. But in the year in which you will transfer this new property within 3 years. Yes or no? Now one more thing. This new property you purchased, and for this exemption is available. Other than this new property, what did I say? Other than this new property, another property is purchased within 2 years, or another property is constructed within, then also this will be revoked. So this new property should not be transferred within 3 years, then it will be revoked. Or other than this new property, any other property is purchased within 2 years or 3 years, constructed within 3 years from the date of transfer of original asset. What was your original asset? Jewelry. So the date of transfer of jewelry from that date, within 2 years, another property is purchased. From the date of transfer of jewelry, another property is constructed within 3 years. Then also this 2,60,000 will be revoked. Only this property has to be purchased or constructed within 2 years or 3 years. Only this property. Other than this additional property, take it back. Or this property also transferred within 3 years, this will be taken back. Getting my point? This is 54F over. Total investment. What did I say? Total investment out of your net consideration in the new property cannot be more than 10 crore. Any investment in residential property in excess of 10 crore will be ignored for 54F also. 54. So maximum 10 crore can be invested in purchase or construction of new residential property, and also maximum 10 crore can be deposited in CGD account for purchase or construction of new property. Getting my point? Any investment over and above will be ignored. It is ignored for section 54 also, and it is ignored for section 54F also. But remember, under section 54, if the long-term capital gain was up to 2 crore, so you could invest in 2 properties, but that option is not available under 54F. Getting my point? With this, exemptions are over. Please try the questions at home today, having this exemption. Very easy question. And trust me, if a capital gain question is there in the exam, no, full-fledged question, they always exploit exemption also in that question. They will exploit. And which exemptions are most important? 54, 54EC and 54F. These 3 exemptions you are supposed to keep in mind. Yes or no? Now see, the tax rates on capital gain. Very easy. Very easy. Tax rates on short-term capital gain. Which capital gain? So short-term capital gain arising on transfer of listed equity shares, units of equity-oriented mutual fund, or units of business trust, which are transferred on or after 1st October 2004 through any recognized stock exchange, and on which STT is paid on transfer. So do you have listed equity shares? Yes. Do you have units? Yes. Units of equity oriented mutual fund, or do you have units of business trust? Yes. Period of holding is less than or equal to 12 months. So they are short term. They are being transferred on a recognized stock exchange, and at the time of transfer you are paying STT also. So it is known as STT paid short-term gain. What will you call it? And this short-term gain is covered under section 111A. This type of short-term gain is covered under 111A. Bring this short-term gain under 111A and take the, pay the tax at the rate of 15%. At the rate of, but 15% is an old rate. It was applicable if the transfer was made prior to 23rd July. Now the same transfer of same asset will be made on or after 23rd July. Now the rate of tax will be 20%. Will you remember this? Hello? Now if you are transferring jewelry and short-term gain of jewelry is there, you will cover that under 111A, no? No? Huh? You will cover the short-term gain of jewelry also here, no? You will cover the short-term gain of land, building, unlisted shares. All short-term gain are covered here. Only the short-term gain of this asset by satisfying this condition. Take the name of three assets. Listed equity shares, units of equity oriented mutual fund, units of business trust, and they are transferred on a recognized stock exchange. And at the time of transfer, STT is also paid. If all the conditions are fulfilled, then any short-term gain resulting from these assets is known as STT paid short-term gain. It is known as, and that STT paid short-term gain will only be covered under 111A, taxable at 15% or 20% as the case may be. Any other capital asset resulting into short-term gain, meaning any other short-term gain, don't even dare to cover that under section 111A. That will be covered as a part of your normal taxable income. Yes or no? So all the, what did I say? All the short-term capital asset, any other short-term capital asset which is not covered here, if the case is not covered here, on that capital asset, if the short-term gain is calculated, that short-term gain will be taxable at what rates? This is your normal income, just like your PGBP income, just like your house property income, just like your salary income. This is also your normal income. Pay the tax at normal rates. Will you remember this? Hello? Will you remember? Tax rate on short-term gain is done. Tax rate on. Now see, I will tell you the tax rates on. I will tell you the tax rates on. This note is not that relevant. No need to remember. Okay. Pay attention. Now I will talk about long-term gain arising on transfer of long-term capital asset. Which long-term capital asset? Same three capital asset. Listed, units of equity oriented mutual fund, units of business trust. These three assets, same three assets, yes or no, are transferred on or after 1st April 2018 through a recognized stock exchange on which STT has to be paid on. STT has to be paid on transfer. Wait. STT has to be paid on, but if it is listed equity shares, if it is, so STT has to be paid at the time of acquisition also. This was not the requirement in the case of short term. STT has to be paid only at the time of transfer. At the time of transfer. Whether it is paid at the time of acquisition or not will not make any difference. But here, if the STT is paid, STT has to be paid at the time of transfer for all the assets. But for in the case of listed equity shares, the STT has to be paid at the time of acquisition also. So at the time of buying you paid the STT, and now at the time of selling also you are paying STT for listed equity shares, and the long term gain is calculated, and the long term gain is, their long term capital gain is known as STT paid long term gain. What will you call it? And such long term gain will be covered by 112A. 112A. Under section 112A, the long-term gain of this asset will be calculated. Full value of consideration will be selling price. Full value of the consideration will be selling price. Yes or no? Minus transfer expense, brokerage, etc. will be minus. But no need to take the deduction for STT. Remember, while calculating capital gain, no deduction for STT is available. Not to be added in the cost, not to be treated as transfer expense. STT deduction will not be available. Although the gain are STT paid gain, but no deduction for STT will be available. Will you remember this? So, full value of consideration, selling price, minus transfer expense, meaning brokerage, etc. Yes or no? Net consideration, minus what? Minus what? Cost of acquisition. Now pay attention, pay attention. You are calculating long-term capital gain under section 112A. For which shares? Let's take an example, listed equity shares. Now these listed equity shares were purchased in 14-15, purchased in, and they are transferred in previous year 24-25. Now see, at the time of purchase, you purchased them through recognized stock exchange and you paid STT also. And now today when they are transferred, at the time of transfer you are transferring them through recognized stock exchange. At that time also STT is paid. Yes or no? Now what is happening? When you purchased, at that time the cost of acquisition was, meaning actual cost. Actual cost was 1 lakh. Actual cost was 1 lakh, which is nothing but the cost of acquisition. And today, when you are selling, the selling price is 4 lakh rupees. Selling price is 4 lakh rupees. This is the full value of consideration. Now see, tell me, are you calculating the capital gain under section 112A? Why? Simple. Asset is listed equity shares. Hello? At the time of purchase, STT is paid. At the time of sale, STT is paid. And the transfer is happening on or after 1st April 2018. On or after 1st April 2018, meaning in my previous year if the transfer is happening, yes or no? Then the capital gain are STT paid long-term gain, which I have to calculate under section 112A. Now what section 112A says, that whenever you are going to calculate this capital gain, whenever you are going to calculate the capital gain under section 112A, remember, cost of acquisition, there will be no indexation, and calculate your capital gain properly. Now tell me, what will be the selling price? What will be the selling price? That will be the full value of consideration. Selling price was 4 lakhs. Yes or no? Minus transfer expense, any brokerage, etc. But in our case, we are keeping the things simple, so I'm not including brokerage. Okay. Otherwise in the question definitely brokerage will be given. Okay. So now tell me, net consideration will be 4 lakh. Minus what? Cost of acquisition. Minus cost of acquisition. What is the cost of acquisition? 1 lakh. Without taking any indexation benefit, reduce the entire cost of acquisition. And what will be your gain? 3 lakhs. This 3 lakh is your long-term capital gain covered under section 112A. Now see, up to 1 lakh. What did I say? Up to 1 lakh, the gain was not taxable, and excess amount of gain is taxable. Excess amount of gain is taxable. Excess over and above 1 lakh is taxable at the rate of 10%. So first you'll have to calculate this gain. Show this entire gain in the computation of your total income. Entire 3 lakh will be shown in the computation of your total income. But whenever you will calculate the tax, at that time, don't calculate the tax on first 1 lakh, calculate the tax on excess amount. And that tax also will be 10%. Will you remember this? But if the transfer takes place on or after 23rd July. So the rate, this limit will be increased to, limit is increased to 1.25 lakhs and this rate is increased to 12.5%. Now up to 1.25 lakhs, what did I say? Up to 1.25 lakhs, there will be no tax. And any excess over and above 1.25 lakhs, on that 12.5% tax rate will be there. Earlier the tax rate was less, now the tax rate they have increased. But to compensate with that, they have increased the limit also from 1 lakh to 1.25 lakhs. Will you remember this? Yes or no? Now pay attention. Pay attention. Very important point I am going to discuss now. This 1 lakh rupees is the cost. 1 lakh rupees is the, what did you take? What did you take? Actual cost will be taken only if the shares were acquired on or after 1st April 2018. Sorry, 1st February 2018. What? While calculating the long-term gain under section 112A. While calculating the long-term gain under section 112A. The cost of acquisition has to be reduced. That cost of acquisition will be actual cost only if the shares are purchased on or after 1st February 2018. But if these shares were acquired prior to 1st February 2018, then grandfathering will happen. The cost will be determined as per 55(2)(a)(c), which I left, if you remember. 55(2)(a), 55(2)(AA), 55(2)(ac). That AC will come right now. Oh my God. See, listed equity shares for which LTCG under section 112A is computed. Now you have to see whether this listed equity shares were purchased. Purchased means acquired prior to 1st February 2018 or on or after 1st February 2018. Prior to 1st February 18 or, see, on or after 1st February 18 you are taking, no? So cost of acquisition to calculate the capital gain will be actual cost. No problem. But if it was acquired prior to 1st February 2018, then the cost of acquisition will be A, actual cost, or B, we will give you the option to take the fair market value as on 31st January 2018. We'll give you the option to take the fair market value as on 31st January 2018, the date immediately preceding to the budget date. On this date the budget came, and in that budget our government considered this long-term gain taxable. Earlier this type of long-term gain used to be fully exempt under section 1038. So whatever gains which have happened prior to this date should not be charged to tax. Yes or no? Only the gains happening after this date should be charged to tax. Getting my point? And in order to do that, what we are going to give you an option that if you want, you can take the fair market value as on 31st January 2018 as your cost. But remember, this fair market value should not be more than the selling price. This or this, whichever is lower. So this lower amount will be your B amount and the actual cost will be there, A or B, whichever is higher, that you can take as cost. Getting my point? So now tell me, in my example which I took, listed equity shares were purchased on prior to 1st February, prior to 1st February or on or after 1st February? Prior to. And what is the actual cost? I cannot take this. I cannot take this. But for you all to understand, first I had to do this thing. Yes or no? Now, in this question, 100% they will give you 31st January 2018. 31st January 2018. What was the fair market value? The fair market value was 2,50,000. 2,50,000. Now tell me, will you take actual cost or you will take fair market value? Whichever is higher. Whichever is. So, actual cost is 1 lakh and the fair market value is 2,50,000. But remember, your fair market value should not be more than selling price. It is not more than selling price. Sir, selling price is 4 lakh only. Selling price is. So tell me, 1 lakh or 2,50,000? Whichever is higher. Whichever is. How much cost you are going to take? Actual cost will not come. The cost will be determined as per 55(2) AC, which says that actual cost or fair market value as on 31st January 2018, whichever is higher, 2,50,000. And this 2,50,000 we are taking since it is not more than your selling price, because your selling price was 4 lakh. Getting my point? Tell me, how much will be the gain now? How much will be the gain now? Up to 1 lakh, no tax, and excess amount 10%. But if the transfer is taking place on or after 23rd July, up to 1,25,000, no tax, and excess amount. Simple logic I am telling you. Total gain was 3 lakhs. Total gain was, out of that 3 lakh gain, 1,50,000 gain relates to that period when the capital gain was exempt. Avoid. On that the tax should not be there. Only the gain after you came to know that now these gains will not be taxable with effect from 1st February 2018. Whatever gain will be there, on those gains only the government will be charging the tax. This is known as grandfathering. Yes or no? Hello? Now pay attention. The same example I am changing. Same example I am changing. Pay attention here. What fair market value we took? Fair market value. What was the fair market value which we took? 2,50,000 was the first example, no? Now, fair market value I am keeping 2,50,000 only. 2,50,000. And here the selling price I am taking 2,10,000. Possible, not possible? Possible, not possible? Now, let's go and solve the question. Selling price will be 2,10,000. Transfer expense nil. Net consideration will be 2,10,000. And guys, now if I take actual cost of 1 lakh or 2,50,000, whichever is higher, 2,50,000 will be my cost, and there will be a loss of rupees 40,000. Loss of rupees. Bloody, there is no loss happening to me. Cost was 1 lakh, I am selling the shares for 2 lakh, there is a 1 lakh rupees of gain. There is no loss happening to me. And that loss will be calculated if the fair market value is not restricted to the extent of selling price. So what was your actual cost? 1 lakh. What was your actual cost? Actual cost was 1 lakh. 1 lakh or fair market value, whichever is higher, but restrict your fair market value to the extent of, your fair market value cannot be more than. So how much is your selling price? How much is the fair market value? Can you take the full fair market value or fair market value to the extent of 210 only? 210 or 1 lakh, whichever is higher. Now tell me, this will be 2 lakh 10,000 and the notional gain of 40,000 which you could have calculated will not be allowed. Now there is no capital gain, nil. Will you remember this? Last example. Last example. Why? हट. तो अभी ज्यादा पढ़ लिया तो क्या करें? Oh, I have taught more. So, loss for you, no? Fair market value was 60,000. Was, and the selling price was 80,000. Calculate the capital gain. Calculate the capital gain first. Simple. 80,000 will be the full value of consideration minus transfer expense. Net consideration 80,000 minus cost of acquisition as per 55(2) AC. Actual cost 1 lakh or fair market value 60,000, whichever is higher. But remember, your fair market value should not be more than, fair market value is not more than selling price. So I will take the fair market value or actual cost, whichever is. Actual cost is higher this time. So will you take selling price 80,000? Net consideration 80,000. Now what will be the cost? What will be the cost? Negative 20,000. Actual loss will always be calculated. But notional loss will not be allowed to be calculated because the fair market value is restricted to selling price, so that you don't calculate notional loss. But whatever actual loss is happening, that actual loss will always be allowed. 1 lakh bloody you bought the shares and today you are selling it for, actually 20,000 loss is there, no? So 20,000 loss is calculated. Sir, long-term loss can be set off against? Long-term loss can be set off against long-term gains, yes or no? Now pay attention. Long-term gain under section 112A, under section 112, up to 1 lakh, not taxable. 1.25 lakhs, not taxable. Over and above that, taxable at 10% or, can I say long-term gain up to a certain limit is not taxable? If the long-term gain is calculated under section 112A, that long-term gain is not taxable up to a certain extent, and over and above that it is taxable. What if there is a loss? Instead of calculating the gain, we were calculating the gain, but instead of gain, the loss is there. This loss is also calculated under 112A only, yes or no? Will it be set off? Or up to 1 lakh ignore, up to 1.25 lakh ignore? That restriction of 1 lakh and 1,25,000 is available only in the case of gain, not for loss. Loss, whatever may be the amount, less than 1 lakh or 1,25,000, up to 1 lakh or 1,25,000, more than 1 lakh or 1,25,000, entire amount of loss will be allowed as set off. Will be allowed as set off. No need to give the restriction on the loss because the law has not put any restriction. Yes or no? Hello, sir. So, see, this was the only part which I was supposed to, get into detail. Okay. So this part I have covered. Now tomorrow we have a lot of things to do. First of all, I'll tell you, tomorrow I will pick up IFOS, finish IFOS, and directly we are going to start with total income question. In that total income question only, the deductions will be covered. Clubbing part will be covered, and any set off etc. will be there, will be covered. Meaning all these small chapters which are there after IFOS will all be taken care of while solving the question. And once I'll solve few questions with you, the syllabus will be over. Yes or no? And then I will tell you which important parts from return of income and TDS which you are supposed to go through. Okay, go through only those things and you are done for that. Okay, So I'm here with you for another 2 days maximum. Okay. So within 2 days we'll cover up the entire syllabus, and small these chapters are there. These small chapters will be taken care of while solving the questions. I want to solve questions for last 1 or 2 days with you. Okay. So we'll see you tomorrow, and this thing, capital gain is over. Okay. Bye.